Kikyo is Dylan Radigan in Milan. Yours truly, Ilya Spivak in San Francisco. This is Overtime. Welcome, everybody, on a day when the Fed gave the markets all kinds of things to think about, and think about it they did. Gentlemen, how goes it?
It's going well. It's a crazy move we got here. We were looking at the SPX expected move for this afternoon. It was like 25 points. I think it was 40 or 50 points for the rest of the week. And here we are down 220 points in the E-minis. Huge move. And if you look at it,
why, Ilya? Tell us why. What's the problem, man? You got your rate cut. Just calm down. I don't understand the problem.
So it's interesting because I thought the Fed was actually going to be more gradualist than what they ultimately did. But what they did was they basically lined up their forecasts to where market expectations have been. So when they came in September and said 100 basis points for 2024, same for 2025, the market said, yeah, no, that's not going to happen. And the reason they said it was because the economy was already heating up. And so they said, okay, fine, you'll do the 100 basis points for this year. We believe you there, but you're not going to do 100 basis points next year. And what they've done for basically 2.5 months, from mid-September into mid-November and into the beginning of December, was ride up yields, ride up the dollar, build out inflation, reflation expectations into break-even rates, which is the difference between nominal and real bond yields, as if to say, you're dumping stimulus on a hot economy. That's going to give you more inflation downwind. And what all of this is going to mean is you're not going to cut 100 basis points. So going into this meeting, they finished the 2024 forecast as foretold. So we got the 100 basis points for this year. But the market had them only at 50 basis points for next, and they confirmed. So they took their September forecast and cut it in half. I thought they were going to cut it by less. I thought they were going to be more gradualist. They were not of that mind, clearly. And the conversation that Powell had after was very hawkish. He basically came out and said, look, we're not saying this is the last cut, but we are saying we can move much more slowly now. The language of the statement echoed that. They adjusted the wording to basically say we can go slowly here. We're not in any kind of hurry. And the market clearly responded. Yields went up. Gold went down. Dollar went up. And stocks didn't get as much cheap money as they wanted. And so they got knocked back by a good amount here, basically across every.
So how do you like the Sosnofian long bond extravaganza? Bitcoin rolls over, Mag 7 rolls over, dollar comes back in, and bond moves like a proper risk-off security.
Well, so I still am a little bit long, the long end. I have a TLT call on still, basically on the idea that maybe we're going to hold these lows. So I'm looking at it and basically seeing how this is going to land. If we can look at a chart of ZB here, we can see it's basically sitting at the bottoms that we were carving out in mid-November after that big run-up in yields. So I think that's really where we're looking here.
Yeah, we're seeing a big spike
Would
in
you
the 2-year.
So go ahead, Bill. Sorry, Mike. Sorry.
No, you're good. I was just looking at the 2-year and 10-year and 30-year, and we're seeing huge spikes there. But yeah, it's definitely needless to say, it's an outside of the expected move that we were looking at today. The market was basically snoozing with a 25-point move going into a Fed interest rate announcement, and we're seeing massive adjustments in the market today, reflected in the E-minis, the Nasdaq, bonds, but especially the VIX too. Like, this is pretty wild. We were actually talking about this today. We were like, what does it take for the VIX to go from 15 to 30? Here we are.
Yeah. I mean, just looking at the Nasdaq alone.
And you're saying that's the Powell. That's all in Powell's comments, basically.
That's Powell, and that's the policy statement. Yeah, I mean, the guidance here clearly much more hawkish. So just to give you a sense, inflation for next year, the expectation adjusted from 2.1 to 2.5. Core inflation from 2.2 to 2.5. The unemployment rate down from 4.4 to 4.3. Economic growth from 2 to 2.1. Rates adjusted, they were supposed to end up at 3.4 at the end of next year. Now they're going to end up at the same level, 3.4, but at the end of 2026. So they've basically pushed out by a year relative to September. So now, instead of getting 100 basis points next year, we're going to get 50 next year, according to this, and then another 50 the year after that. So the Fed has essentially decided that they're now having to slow walk. It'll be really interesting if ultimately this is not how it works out, because the economy disappoints, and there's all kinds of reasons why it might. But Powell was very confident. He was talking about, we had a great year, growth has outperformed, I'm expecting the same thing next year. And the market clearly read that as the cheap money isn't coming nearly to the extent that we thought.
Yeah, I think what's interesting about this move too is you're seeing kind of a risk off everywhere, except for the 30 or 2-year, 10-year, some natty gas movements, some volatility. But when you look at the E-minis, the NASDAQ, silver's also down 3%, gold's down 2%. What do you make of that, where we're seeing kind of a macro everything sell off, as opposed to different sectors that are related to equities that have, in the Mag 7 stocks, that have gone nothing but straight up?
I mean, there's a lot of this that comes directly to what happened with the dollar today and what happened with yields, right? Gold absolutely hates a strong dollar and higher yields because it is a natural foil for fiat, and it is a natural foil for interest rates because it doesn't yield anything. So when interest rates go up and the dollar goes up, the appeal of gold is necessarily diminished. I think what's really interesting about this gold move is actually that it couldn't sustain the larger sell-off, which makes me a little bit happier to be a little bit long GLD here. I got long on this pullback from, let's call it, 4 days ago, 5 days ago. I got a little bit long once we got back into that congestion range, basically on the idea that gold was pulling back because of anticipations of the Fed, but it broke out because China restarted buying gold for their reserve accounts and ended up with basically the first increase in November of gold reserves since April. And from April, looking back, they were buying everything that wasn't nailed down in the gold market for 18 months straight, and at a crazy clip. So if they've basically found that the price is right for them to go again, I thought, okay, well, if gold goes on any kind of discount, let's see if we can take a shot, because that's a non-economic, non-macro sensitive buyer out there just scooping. So I'm pretty happy with that. But everything else, you look across the board and it's dollar strength and yield strength. Dollar-denominated commodities down. Silver, obviously, very much a part of that story. Silver is kind of this mutant metal where it's a precious metal, but it's got some industrial uses, so it's got some sensitivity to risk and the business cycle. Absolutely smashed. You look at what's going on really across the board. Probably the only thing that tells you it's more a yields move than it is a risk on, risk off move is the yen. You would expect the yen to strengthen in a risk off move because what you'd see is an unraveling of carry, right? All of those people that essentially say, well, as long as sentiment is good, we can short a bunch of yen effectively because we can borrow in yen for next to nothing, use that money to buy other things. And so essentially we're shorting borrowed yen. And if there's risk aversion and we don't feel comfortable in those kinds of bets, we have to close them out, buy back yen. So and cover our loans. So yen tends to go up in a risk off market. Today it was obviously lower because the yield differentials moved in the dollar's favor with this jump in yields. So that's probably the only thing that sort of gives me some pause in saying this is a pure risk on, risk off kind of a dynamic. It looks more like basically the Fed just ran roughshod over everything.
But I mean, it's the interesting thing, again, going to our sort of blasé attitude coming into this, not just ours, but the market, is that the Fed did something, in this case, adjusting expectations to much less cutting, higher for longer, right?
Yes.
To use our sort of cliched rhetoric.
Yes.
But they've introduced a bunch of higher for longer.
Yes. They've introduced a very big dose of higher for longer. And I went into this thinking they were going to be more gradual, because everything they've been saying is, look, economic data has been volatile. We don't need to over extrapolate. We don't need to over interpret. We're fine tuning. We're near neutral. We don't quite know where that is. We don't want to over tighten because we don't want to unduly hurt the economy. But at the same time, we very much want inflation to still get to 2%. We don't want to let that slip. So my sense was they were going to walk slower, but they did not do that. They basically said, okay, the market told us 50 basis points for next year. We're going to basically line ourselves up with where the markets are.
But so how do you interpret that? In other words, you didn't expect it, and no one in the financial markets expected it based on price action.
I think what I and what most of the markets expected was that the Fed was going to take the forecast in September and make it less dovish. This, I think, was not controversial to anyone. The Fed's been talking about it for long enough, and the markets have done the repositioning for it. The cut itself was fully baked in. If you looked at Fed funds futures ahead of this for a few weeks now. So that much, I think, was clear. I think the extent to which the Fed signaled maybe they're done for a while, maybe higher for quite a bit longer, I think that's what shocked. And I think the other element is it was pretty thin recently. Basically, since Thanksgiving, markets have been on the thin side, and that might be amplifying volatility here. Mike, how do you feel about volumes today? Do they seem a little light in your mind?
I mean, it's felt pretty light this month, like you've said. We can usually see it just by looking at the speed of the ticks in the market, but looking at this on the lower half of this chart here, you can see we've had some high volume, but really nothing this month. If we look at and isolated for December in SPY, we can look at the E-minis, but just looking at SPY, like the volume today is significantly more than what we've seen if we were to take one day at a time for this month.
Almost 85 million, yeah.
Yeah. So yeah, volume in SPY almost 100 million today, which is huge. We were looking at days a couple of weeks ago, we were looking at like Tesla or even IBIT. IBIT at certain points when Bitcoin is moving around, IBIT had more volume than SPY and the Qs combined. So it was really more of like a Bitcoin runs everything now. Tesla's mooning. There's no down days there. And the rest of the market was kind of just fluttering around. But we're seeing a big difference today, especially looking at SPX expected moves for the rest of the year. At the beginning of December, we looked at this and the December 31st cycle had closer to 100-point expected move, 130-point expected move. And that was December 1st. Now we're at December 18th, and we're looking at a 14-day, 13-day cycle that boasts a 220-point move now, which you would expect with the increase in implied volatility with the VIX ripping higher. But this tells us that this isn't something that we should just brush off. I think we might see some more market adjustments given what we heard today.
But so would you take this as an indication, Mike, of the Sosnofian reversal? Like, are we now short the Mag 7, short the crypto, long the bond? Like, bring a little convert, long a little Uber, short a little Tesla, all that extremity reversion kind of vibes?
I mean, it's a good question. I've been of the mindset that this market moves faster than it ever has before in terms of the market adjusting and reversals happening. Of course, if you look at the size of this red bar in SPX, this is probably the biggest red bar we've seen for this whole year, honestly, which is kind of crazy to say. But at the same time,
don't I know it?
Yeah.
As a frustrated bear.
We've seen this happen before where you see a big red bar and then the next couple of days we've completely filled the gap. I think a couple of concerning things might be the VIX popping to 30 in one day. You don't see that all too often. Here's the where the Japanese yen unwind happened. Kind of a similar story where the markets sold off aggressively, but what happened after that? Of course, there's a different reason for it, but we've seen some volatile movements and some V bottoms before. So I actually went in and placed a bullish trade in the Qs, but I did it in a defined risk way, and I did it much further out in time. I did a call diagonal spread. I bought the March cycle 520 call, and I sold the Feb 540. So just playing for a reversal, even if we get a 50-point or 60-point reversal tomorrow, this will be a nice winner that can take off. But just looking to play the potential two-sided action here in the chop into this big sell-off that nobody saw coming.
Well, and to your point, Mike, I think if you look at the S&P, you've had some major trend changing kind of moves. If you look at the situation in the Qs and in NQ, that's not what you see. Obviously, you get a really big down day here, but it ultimately lands where sort of former resistance became support around, let's call it the November 11th high. So you've basically erased all of the rally from the beginning of this month where you broke out to new highs, but you're kind of back to the mid-November top, and you're retesting it from the other side. So let's say this is a major top. Let's say this is a trend change. Over the course of the next day or two, you might get a reaction bounce off that level. So if nothing else, I'm not looking to sell NASDAQ here. Let's erase half of this red bar over the next day or two, and then I'm a much more curious seller. Although I did go into this with some put verticals in IWM and in and that one I've had for about 2 weeks already, but I put on some SPY ahead of the Fed as well, some put verticals. So that's happy thoughts for those of us over the bearish position. But NASDAQ, I'm not ready to make that kind of commitment to.
I mean, can I ease you into a short NVIDIA, a short Tesla, a short Google, Mr. Spivak, my Russian friend?
I'd rather trade the index.
Okay, so can I ease you into a triple Q short?
Let's erase half of this red bar over the next 2 days, or let's convincingly break down through the 11 November high. So let's say under 21,300, 21,250, and then I'm in.
Butler, triple Q short between friends.
I can't get on board with that personally because I've been conditioned to buy every single dip that I see. However, the Tesla, I actually like the Tesla short. We've been talking about this one too. This has
first buddy short.
Yeah,
the first buddy short, I think, is the official name henceforth.
This has behaved like a meme stock, really. I mean, it's ever since the election, we've seen it go straight up. But with that momentous rally, we've also seen implied volatility go up as well. So placing a short here, I think an interesting dynamic with this market in particular, what you could see is you could see Tesla come down in price, but also have a volatility collapse. So I kind of like the idea of selling a short call spread, or if you have the ability to, placing a larger downside trade where you can take advantage of that vol collapse. Because I think, when you have products that are moving this much to the upside with a vol expansion, you would expect to see a vol collapse into a down move, even though it's historically not how you would expect an equity to behave. Equities are different these days. When it comes to these specific ones like Tesla or MicroStrategy, they're very much like volatility products where if they're ripping higher, volatility is expanding too.
Yeah.
So long-winded way of saying I'm on board with the Tesla short for sure. It's down 40 points today.
Are you on board with the Uber long? Are you on board with our Tesla Uber pairs trade, long Uber, short Tesla on the self-driving car convergence, reversal?
I could get down with that. I mean,
okay.
Yeah,
it's not hard to
the
get long
idea there,
something at
Mike, is
lows.
that Waymo is way ahead of the game, and there's only so much that the first buddy can do to convince the administration to specifically put a target on Uber's back.
It's fair. But yeah, I mean, getting long something at lows. I think another interesting product, we're talking about getting short NVIDIA and Tesla, but an interesting competitor is something like AMD.
Yes.
Or even MU. They had earnings today. They're down 10 points after the close, likely in sympathy of this market. But AMD is something has been participating normally in upside movements with NVIDIA, but not so much recently. Kind of a big disconnect there between AMD and NVIDIA.
Yeah. I mean, one of them, I think some of these AI names are so heavily weighed in NASDAQ now that if you're going to do anything, you might as well go hit the index itself, because if these things go, you're just going to get better liquidity in the index. You're going to get better fills. You have less idiosyncratic risk in case what happens in every one of these types of things before happens here again. And what I mean is, of course, every time you get this kind of a transformative technology breakthrough, kind of industrial revolution type of thing, be it railroads or telecoms or whatever, there's always a build out phase and a hype phase. And then it turns out everybody's overbuilt and overhyped. There's a crash of some amount. It doesn't have to be insane, but there's some kind of a reshuffling of the deck, and then the real transformation happens. And what happens in that reshuffling of the deck is usually the finding of the pets.com of the world. So a bunch of weak hands get shaken out, a bunch of fraud is discovered, a bunch of nonsense falls away because the valuations stop papering over whatever is hiding under the surface that sort of came out of the hype cycle. So with AI, I'm very reticent to pick names, but I'll definitely short the NASDAQ once it looks like it's crossed some sort of line. And Lord knows I've tried a few times this year. It's thankfully made more money than lost, just because I've always done it in a very risk-defined fashion. So although I've gotten more trades wrong than right, I've made more money on the ones that worked than I lost on the others. And that's been okay. It's not a huge margin, but thank God for risk management and defined risk verticals. So as I look at this now, I'd rather short the index than NVIDIA, because it's basically the same idea, but with less individual
But Ilya, or I said this is a question for all of us, but I'll pose it to both of you. Is the stock market this afternoon different than it was this morning because of the reframing from the U.S. Central Bank?
It's certainly different because of the way the price action decided to react to the reframing from the central bank. And I think that's ultimately what you have to listen to. If the market decided that this was a catalyst,
we've been in the most optimistic market ever in the history of humankind.
Yeah.
Is that over as of today?
Maybe. The price action in the S&P certainly, I think, is telling you that what you're seeing, at least for the overall kind of, if you want to say the S&P is the catch-all, right? It's the thing that subsumes tech and this and that and the tariffs and whatever.
Retail banks, whatever
the whole thing, right? If you look at that, what you find today is that the series of higher highs and higher lows, by definition, an up move, a trend higher, since August, is broken as of today. So the rally from the August lows is
And what about the rally from
here.
the presidential election? Also broken.
Oh, of course, gone.
So you're saying Butler, you buying all this because you're the king. Butler's got $50 billion in the bank because he buys the dip, by the way. So
Wait, hey, that's been the right move all year. And those of us that are
you buying
frustrated
the dip,
bears
Michael?
have looked at this and going,
Well, it's funny we're saying this because I'm thinking in my head, like, you're asking us, is it over? Is it over? My answer was going to be, let's see what happens tomorrow. Because honestly, if we see the VIX go from 30 to 20 and we see a 100-point rally in the E-minis and a 500-point rally in the NASDAQ, then, maybe you chalk this up to a knee-jerk reaction. But I feel like these markets are just moving so quickly now and everything is so efficient that there's no, like, the world of a bearish market that lasts for 6 months, like, where is it? How do we get back to that? What's going to be the catalyst to get back to that? And until that happens, I'm just conditioned to buy every dip. Like, I'm speking for all millennials here. This is like every
as an elder millennial that lived through 08, I disagree.
but you're basically saying, show me why. You're saying, why would I not buy the lower price? To be simplistic.
Yeah, and I feel like that's been the narrative of the year, right? Every single dip has reversed.
Clearly,
it's been crazy.
Yes,
but. Yes. Going back to picking different stocks, I think an interesting way to look at this is, here's the NASDAQ 100 watch list. We sort it by the products that have not moved in a big way. If you look at the biggest movers, Tesla leads the way, down 8%. But here's NVIDIA on the other side, down 1% today into this huge sell-off. So does that make you feel like NVIDIA is a little bit more resistant to something like this, where there's less sellers in NVIDIA than there are in Tesla that's realized, obviously, the crazy rally? But does this make you more confident in getting long NVIDIA into a sell-off like this? For me, I would say, yeah. If you have a product that is top of mind for a lot of tech investors that's kind of ignoring this move today, maybe that means if there's a reversal, it's a more confident pick to see NVIDIA rally tomorrow or the next week if it does reverse.
You should, by the way, to Mike's point, be looking at something that is not selling off in what is a basically bulldozer through risk sentiment, something that's sort of notably outperforming and going, well, that must be something that's really strong, because if it can't come down on bad news, then there's something under the surface there that obviously imbues the market with a lot of confidence. And NVIDIA is not up today, clearly. But the whole kind of tech artifice and NVIDIA itself are holding up much better than broader averages. Russell got absolutely shellacked. So did the S&P. So did the Dow. And obviously, it's a big down day in NASDAQ, but it could be worse if you sort of look at equivalents elsewhere. I think one of the interesting things here, if you look at the current active contract for NQ, so NQH5, because obviously we've made the switch already, what you see is, if you then look at where the July 10th high is, and then where the November 11th high is, that sort of gives you a range of, let's call it 21.4 to 21.6. And that's a kind of former highs where we've had big rejections lower. That's holding at this point as support. So to me, that's the line in the sand. You get under that line, you're in a different world, just in terms of the way the price action has positioned itself. And in the S&P, this is a line we've crossed. So when we come back tomorrow, if there's not a big reaction bounce off these levels, I'll probably sell more SPY. And if NQ clears these levels, I'm probably going to be selling Qs. But while this is holding, tough to make the case that the risk reward, even just forget the directional bias, that the risk reward is attractive to be selling directly into support.
No, I mean, I think that anytime you have an extreme price move, I mean, this is sort of a classic example because I have for sure been less profitable with my trading because I tend to be much more conservative. And if I had more Mike Butler in me, I would be much more successful. Whether that's Mike Butler, whether that and probably and Alford and sort of and it's sort of it is but eventually you're like, well, one of these days Butler's going to be wrong and he's going to get his head ripped off.
True.
But is he going to lose more money on that than he's made the entire way up?
Probably not. Probably not.
No.
And
see, those of us that are elder millennials that are like right on the line and lived through 08 as market participants, but early in our career, like I started in the markets in 05, so 08 is very fresh for me, and the entire buildup into that, I think to some extent we're kind of conditioned bearish, and we have to constantly look at things that look weird and exuberant and powered by cheap money and be skeptical and go, we know how this ends. This ends in tears. And the problem with that kind of this position is you're probably right, but the market can go in the wrong direction and against you by a lot before that happens, sometimes years. I mean, the 08 crisis was a crescendo on something that started like 2 years before, as far as its sort of expression in markets. So it's a thing to overcome. It would have been better, obviously, not to have been as reluctant to buy stocks this year as I've been. Thankfully, I've not stayed in shorts longer term. That would have been a disaster. But nevertheless, I mean, it's difficult to want to bet against a market that, like stocks, likes going higher and prefers a direction and is biased, as opposed to, let's say, currency markets or commodity markets that are more a two-way equal opportunity sort of thing. Who knows? This could very well be absolutely nothing in 2 weeks.
We shall see. But honestly, that's why I've liked these diagonal spreads into these big moves, because the VIX popping is a reflection of a 30-day-ish volatility spectrum, where these diagonal spreads, like I went out and I bought the March cycle for the Qs, which is still popping an implied volatility today, but not nearly as much as the 30-day or the 15-day or the 45-day. Sure. Like you can see it visually, and you can weigh it against the expected move. So like I'm buying this 24% IV with a 44-point expected move over 100 days, and I sold the 65-day implied volatility of 35-point expected move. So even if you just extrapolate this based on time, there's plenty of more premium in the 65-day or the 30-day even relative to the 90-day. So I like to buy the further out premium that's more time-based and sell the implied volatility that is popping today that's much more IV-based. And even if I'm wrong, even if the Qs drop tomorrow, there's still plenty of premium in this option. Like the raw value of this option, the 520 call was $2,300. The 540 call was $890. So reducing basis by 40% and if the market continues to sell off, it'll dull the pain tomorrow. There'll still be pain, but my whole play with this is just to see if we get a 40-50 point pop, and if that happens, this will be a $100-$200 winner. You can take it off, and that results in a 15% return based on monetary risk, and especially into these big moves. Mm-hmm. I just like to keep risk defined, because then you know exactly what you're getting into. And these trades have high potential return on capital too. So if there's let's say there's a 100-point reversal or 150-point reversal, like this could easily be $1,000 winner tomorrow, just because of the profile that it has. So I don't know. I'm conditioned to buy the dip, and I'll cross that bridge when we come to it if it doesn't happen and we keep selling off. If the bird flu shuts us down again, then maybe we're looking at something different.
Well, and to your point, which part of this risk remains on the table? Not very much, right? So the two big things for this year, if you want to kind of look thematically for what the markets have cared about this year, they cared about when the Fed cuts would be and how much of them there would be, and they cared about the election. Those things are in the background. We've crossed both of those things. And this was the last bit of Fed crossing that there was to do today. At this point, everybody is going back to sleep, most likely, for basically the rest of the year. There's really nothing much else that's on the calendar. The Bank of England is coming out tonight, but next week it's kind of light. Into the end of the year, it's kind of light. PCE data on Friday probably isn't going to break any new ground on this whole conversation unless it's beamed down from Mars and is completely different than expected. But that's very, very remote of a chance. So you have the ingredients after a big move like this for people to go, how much follow through are we going to get on this in the next 2 weeks? Maybe not much.
And Santa still has yet to come do his global tour to ring the bell as well. So,
according to Chris, yes, the Santa Claus rally seasonally hasn't even started yet.
Yeah.
So here's the bigger question. The market's either up on techno utopia, AI, superglide,
sure,
writ large, or the market's up on incoming Republican administration, deregulation,
tax cuts,
whatever, taxes, whatever. Or lower rates sooner, cheaper money. And obviously the obvious answer is all three, some sort of constant calculation of all three. And cheaper money sooner was taken away today.
Mm-hmm.
And inflation is real, or reflation, or whatever you want to call it, marginal, right?
Yeah. We haven't really come down on inflation. We haven't had any disinflation in 4 or 5 months at this point.
So now you kind of have a battle between the super glide plus, in Republican deregulatory optimism versus inflation and rates.
And that deregulatory optimism is itself inflationary, because if you deregulate and then you have some tariffs on top and you have some labor market disruption from deporting immigrants there as well, all of that is inflationary. All of that just gives the Fed more ammo not to cut.
I guess what's interesting for me is, at least for the last month, we've been in this unanimous consent of optimistic glory where the Fed is aligned, rates are aligned, deregulatory optimism is aligned, and superglide is aligned. Triple optimism. And today, the optimism of rates and money was taken away, or was certainly meaningfully adjusted.
Yes.
What do you mean?
In my mind, this is what this always comes
down to. But this thing's got to sell off. Come on. Bonds are going to go. This can't be a one and done. Like, look at these charts. But I got Butler over here. He's going to buy this thing. He's going to make a fool of me.
I mean, I think this is what is so critical here. Mike can be absolutely right. And I frankly hope he is, because I want a better spot from which to short things like NASDAQ and from which to add to my SPY shorts. And I'd like those opportunities. But the time horizon for a trade is so critical. You could get a bounce in risk over the next 2 days, and then next week everything gets hosed again. Because the trend, at least in the S&P, looks to have turned. If you have 2 days of upside here, that turn is not going to get invalidated unless that upside is astronomical.
Yeah, I honestly think if we get a turnaround tomorrow or Friday, it's probably a short covering versus like, the masses coming in and buying everything. We kind of saw that today in UNH. Interestingly enough, you had this crazy sell-off, of course, but you finally get, I would call this a short covering rally, honestly. Like, I don't think people are actually coming in and buying this thing. But you might see a similar thing in the markets especially if we do continue to sell off. I think there will be 1 day or 2 days where you get a big green bar just for some short covering. But I feel like this
may well be tomorrow.
Yeah, we'll see. What do you make of the divergence between the 30-year, 10-year, and 2-year? Because for me, I feel like we're obviously seeing the 2-year rip higher, but do you take anything away from the 10-year actually outpacing from a percentage standpoint the 2-year today? 10 years up 3%, the 2 years up 2%.
Seems like what happened here, because the curve steepened a little, only a little, but nevertheless it did, and that's that outperformance for the long end. The move in notes was only the 2-year ZT went down only about 0.25%, and almost a full percent, 90 basis points for the 10-year, and even more aggressive, 134 basis points for the long bond. It seems like what the markets did was they essentially said, this is not just a Fed that's sort of short-term reluctant to cut. This is a Fed that's recognizing that the floor on rates is higher, that the economy is stronger, and that there's less scope to cut. Bigger picture. You saw that in the updating of the Fed's estimate for the long run rate, which is kind of their guesstimate at what neutral is, give or take. They upgraded that again from 2.9 in September to 3. 3% neutral Fed funds rate after almost 2 decades of near zero rates in the U.S. until the most recent rate hike cycle. That's a huge structural difference. And almost a 300% structural difference, depending on when you look. Obviously, if you look, let's say 2014, 15, 16, when you get that baby tightening, then maybe not quite. But the difference is stark. And it speaks to all of the many things that keep inflation higher in this environment, from deglobalization and trade wars, increasing the price of goods, to aging baby boomers and their exit from the labor market, and that making labor supply more constrained and the price of labor higher. On top of, obviously, if you add a deportation scheme over the next 4 years, that issue only gets made worse. So I think the market looked at this today and said, it's not just that the Fed is reluctant to cut downwind, it's that they're looking at maybe there's less scope to cut in this cycle period.
I would say what they're...
And they cut today.
Yeah.
So,
and the underlying thing is, my goodness me, inflation, even if it's at a lower relative rate, is persistent and will persist.
Powell talked a lot about that, actually,
today
at the press conference. He said a lot about, people are responding to the change in price levels pre-pandemic versus now, rather than in inflation as a rate.
Yeah, and we're already seeing, looking at the FedWatch tool, we're already seeing for January 29th of 2025, a 91% probability of staying at this current rate. But if you fast forward to the end of next year, it's exactly what we're talking about. We're at 450, 475. There's a 23% chance we stay there, 40% chance we do a 25 basis point cut, 26% chance that there's actually a 50 basis point cut. So that's interesting. There's more of a probability that we only do 25 versus 50. And then there's a small 10% chance that we end up doing 3/4 of basis points. So, or 75 basis points, I should say.
It's basically a coin toss through May, but once you get into the second half of the year, by June, you're leaning in the direction of another quarter point hike. And then it only escalates. So you have the full 50 basis points in the market now. The really interesting thing here, as ever, is the Fed is reacting to the last thing. It's fighting the last battle. When you look at the way that the markets have kind of sort of read what the Fed is doing, the reason why they ostensibly said in September, you're not going to do 100 basis points in cuts next year, this is a hot economy, is looking at the way U.S. economic data was already starting to evolve. Not even in absolute readings, but relative to expectations. Already in late August, U.S. economic data started to surprise on the upside, and that started to escalate. There's a great Citigroup index called the Economic Surprise Index that measures the performance of data relative to forecasts and scales it by the reactivity of markets, usually currency markets, to that, and just sort of makes that a bigger jump in the index or a smaller jump in the index based on how reactive the markets were and how much they cared. So you see already in late August, the data is starting to heat up relative to forecasts. So by the time in mid-September, the Fed goes, here's all this easing that we're forecasting. The market goes, what, in an economy that's gaining momentum? No. What you're seeing since mid-November now is the opposite, where it's not so much that the data is weakening relative to forecasts. It looks like the forecasts are getting adjusted because they've been so wrong. They've been so pessimistic relative to reality over the preceding 2-3 months that obviously economists have gone back and they said, you know what, it's time to turn these knobs. Our models are wrong. They need to be stronger. And now the data is losing its ability to outperform against those new forecasts. So what you're looking at now is maybe, again, the Fed a step behind. And if the next thing that happens then is a round of U.S. data, it doesn't have to be weak. It just has to be softer relative to expectations. Markets don't move on strong or weak. They move on stronger or weaker relative to expectations, which are already baked in. So you get, let's say, over the next few weeks, a round of U.S. economic data that's a little soggier relative to forecasts, and the markets are going to go, the Fed got it wrong. They were way too hawkish. They're going to have to water this down, and you go the other way.
A lot to digest, that's for sure. On a day where I didn't think we would have to digest really too much at all. So a nice surprise at the very least.
No, I was expecting fireworks. I was expecting for the market to sell off in equities, but I was not expecting the drop in bonds, and I was not expecting the drop in gold. I was actually looking for both of those things to go the other way. So a mixed day for me, but ultimately, thankfully, those things didn't go nearly as far as equities did. Those things didn't go in the wrong direction nearly as far as equities went in the right direction for me. So I'm feeling a little bit happier today versus yesterday. Long may this equity sell-off endure.
We will see. We will see.
I don't know. I would say I still think the game is, if you're going to be short something, whether it's the NASDAQ, whether it's Tesla, whether it's Bitcoin, whether it's Google, what is the most tempting short? I still think it's Tesla, even more than the NASDAQ. Mm-hmm. And if you're going to be long something, what's it going to be? And I feel like it's got to be the bond.
Yeah. I mean, if you look at ZB here, if you look at ZN here, it is very difficult to be a seller because you're basically directly at the bottom of the mid-November range. You're right there. So it's really difficult to want to be a seller of this. I'd say the parallel to this is the euro. If you look at 6E today, what you find is that, yeah, okay, you certainly had a big rally in the dollar. The euro took a big knock back, but you're basically within a hair of the late November low. I mean, are you going to sell into that low directly? Probably not. And it's a similar story for the yen. It's a similar story to a lesser extent for other currencies. I mean, certainly the commodity currencies got absolutely shellacked. Canadian dollar got taken to the woodshed, as did the Aussie. But the euro here not pacing those losses. And if you're going to look for a buy here in some of this, and you're going to think about maybe buying the bond or at least staying long, the flip side of that is maybe going long euro.
You're saying as opposed to being long the bond, those
are parallel ideas.
Right, but I'm saying as in terms of an instrument, you're basically it's long the euro is another way of saying short the dollar.
Yeah. Long the euro would be the same thing as basically betting against the aggression of this yields rally in the U.S. and saying the dollar is riding high on a jump in U.S. yields, but maybe it's basically jumped face first into a wall.
Yeah, I like the idea of placing a bullish currency trade, or even like ZB, I think is I don't want to say a layup. Don't quote me on that, but I mean, if you're looking to place money in a particular instrument, why not bond? Why not the 30-year bond when you're seeing, especially when the crystal ball is clear now. Like we know exactly what is laid out, at least from a probability standpoint. We had the sentiment today. You know, if you're going to be long something and you're not confident that it's going to be the equity world, I agree with you. And you could even you don't even have to use the futures. You could use something like TLT.
This is exactly what I'm doing. Is I'm a little bit long TLT here. I have a little bit of a TLT call. I have a little bit of a euro long in the micro futures, just outright because it looks like maybe we shot the shot today.
Yeah. And this is one of my favorite strategies, specifically in TLT, just a call zebra, where you're ultimately renting 100 shares of stock for $400 here in a $90 product. I actually have this on already. I went out to February and I bought 2 of the 88 calls, sold one of the 90s. You literally have 100 deltas here to the upside, and your risk, if you're wrong, is substantially lower than the notional value of TLT, and your buying power is the debit paid of $400 here. So you really can't beat this level of leverage, and the only way you can get it is because TLT's IV is 16%, and we're seeing TLT move at a pretty high clip relative to a 16% IV. So the realized volatility is there, and I think it could be there if this plays out to the upside.
They had XDIV, I think, today as well.
Yeah, I believe so. Let's see. Yeah, I don't know the exact date. I didn't look at this one too.
It's weird. I think TLT has XDIV kind of back to back twice here this month, and so I'd have to check the dates, but yeah, you look at this and you go, okay, well, you've heard from the Fed. The next time you hear from them is late January. There's probably a mixed case at best for follow through here. And the move looks much less violent than do equities. I suspect, Dylan, to your earlier point, if there is massive risk aversion here and equities keep adjusting lower, at some point the bonds catch a bid, not because of anything other than just haven demand. It won't be about the Fed outlook changing. It'll be about money having to go somewhere.
It'll be a risk off vibe.
Yeah. And with that happy thought, Overtime is out of time here. Don't go anywhere because I'll be back for macro money after a brief break where we'll talk about a little bit more of this carnage, but then also look forward to the Bank of England policy announcement, which is coming up later tonight and might be another hawkish surprise. We'll see what the markets do with that. We just had their inflation data overnight, and that was hot. So we'll see how that goes. For myself in San Francisco, Mr. Mike Butler, thank you for filling in Chicago. Dylan Radigan in Milan. We'll see you all at market close tomorrow.
Hey Doc, your tips on diet and exercise have been illuminating. I'm sure busting my ass at the gym 5 days a week is going to be way quicker than just giving me the skinny shot.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Batten down the hatches, everybody. He's going on the skinny bitch diet. He's going to be hangry.
From the smart mouths at tastylive.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again.
Oh, good.
So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive?
What?
Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh, my God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11?
Oh.
First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but 2 trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
takes the guesswork out of retail trading.
Dear Braden, big thanks to you and the nerds for the wonderful tech support. Of course I back everything up to cloud, because I'm 60 years old and I know what a cloud is. Yours truly, Larry.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
No, your office is right near a different. You're like closer to the.
Near what? This is English. You should watch him read.
From the smart mouths at tastylive.
Having trouble understanding what your trader buddies are saying? Here's what a scalp is. We love those quick profits. A scalp is a trade opened and then closed in a short period of time, usually minutes or hours. A scalp is usually done for a small profit and is typically a very directional position. Scalps are most commonly done with future products because of the liquidity and added leverage they provide. But you gotta be careful, it's not always a profit.
I started trading around 2018, soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or Skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets is the biggest takeaway. And that's kind of just the overarching principle I follow.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
What a day, what a day. The Fed comes out and shocks financial markets. Ostensibly, they deliver exactly what the markets were looking for, at least looking at market pricing, but it looks like everybody, myself included, were looking for a more gradual Fed than what the markets were looking for and didn't get it. So carnage reigned. Now we have another central bank in the offing with still more volatility perhaps on the docket. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we're going to touch on the Fed a little bit. There's, of course, been quite a lot said already, and I encourage everybody to check out the live stream on Tasty Live trending on YouTube of the conversation we just had on Overtime around what happened with the Fed, and then tune in just 30 minutes after we're done with this show to that live stream. After this, we'll be talking with Victor Jones on the price of truth for a full 90 minutes and no doubt dig around the Fed in granular detail. But what we're going to do here today is focus on the Bank of England, which has a monetary policy announcement immediately following the Fed, and perhaps going down the Fed's example and creating a bunch of volatility in its wake. So let's consider here how the table is set, what is expected, why it is expected, and where the vector for market action here may lead. Of course, we'll touch on the Fed a little bit as we go, because needless to say, after a day like this, we have quite a bit of context from U.S. monetary policy. So the expectations here are that the Bank of England is going to keep rates unchanged this time. What we're looking at here is the equivalent of Fed funds futures. These are 1-month SONIA futures, the benchmark rates indication for the Bank of England. And we can see here the current target for the bank rate, the target interest rate, 4.75%. Looking at December, we don't quite have the cut there. We have the next one on the menu, it looks like around March. And then we can see here we get to another one by September, November. And as we can see here, the curve for this policy path into next year is a significantly less steep one than what we saw back in September. The markets were looking for a much more dovish Bank of England, and since then, things have adjusted to a less aggressive setting, to a more measured path forward for rates. We see here, if we look at what's expected for this year, for next year, and then in total going forward here is another 2 rate cuts basically through the end of next year. And that's been a significant adjustment from even just recently. 82 basis points was on the menu when we looked at this as recently as the beginning of this month. In fact, just last week, the beginning of last week, a much more dovish disposition for the markets. And now we're down to just 50 basis points, of which clearly we can see all of the cutting centered on next year. And a lot of this adjustment comes this week and indeed over the past 48 hours, because what we got here in the lead up yesterday was an update of UK inflation data giving us numbers that are plainly going the wrong way. And although we had a situation here where the headline number, the 2.6 percent here that we see for headline CPI, that was in line with expectations. The core reading, a little bit warmer than the markets were anticipating. And so what we end up with is a story about a central bank that is ostensibly being directed into a less dovish direction. Now, the markets, in fairness, had forecasts that looked for a 3.6 reading on the core. At 3.5, it was a little bit lighter, but also an uptick from the 3.3 in October, and at 3.5, the highest that it's been since August. The headline at 2.6, the highest that it's been since March. So inflation seemingly going the wrong way here for the Bank of England. And what's interesting even more than the headline numbers are the components. If we look here at what the contributing factors were to November's CPI, we can see that there was a bit of a bump from fuel, and we can see that was very close to where the contribution was for the previous month. So of the 2.6% year-on-year rise, about 39 basis points was accounted for in essentially energy and fuel. But the real standouts, 51 or 0.51 percentage points, 51 basis points from recreation, about 0.6 percentage points or 58 basis points from hospitality. These were the real standouts. And this has been the case for a few months now. which is an interesting kind of a disconnect because you would think these would be the parts of spending that would be the most vulnerable to the business cycle. If people were going to cut back expenditures on something, it would of course be not on food or clothing or perhaps even on transportation or certainly fuel. It would be discretionary spending, recreation, hospitality. But it's these places where inflation is proving stickiest, even as the business cycle actually seems to be going in the wrong direction. So when we got the updated December Purchasing Manager Index figures earlier in the week, the story was, to put it gently, a disappointing one. We're basically back to standstill on the UK economy. If we recall, of course, PMI numbers work around a center line at 50, where that's neither expansion nor contraction. Above 50 is expansion. Below 50 is contraction. We came in at 50.5 on the composite, which subsumes within it both manufacturing and services. Services wiggled a little bit higher from November's lower reading up to 51.4, but the overall composite at 50.5, that is a rehash of what we saw in November, and that is the lowest reading on UK economic growth that we've seen since October of 2023. So we're talking about the weakest growth in well over a year. And what that's following is a steady deceleration from where we peaked in August. And if we look back even further, here's August. That's sort of the straight line down here. But the top on growth really occurs a little bit earlier. It occurs here. So there's a sort of pickup in the second half of 2023. And as we get into the beginning of 2024, much like in the Eurozone, for that matter, where there was some weakness toward the tail end of last year that the region tried to shake off at the beginning of this one and ultimately failed. Here, a similar story, although not as dramatic. The Eurozone now outright contracting in terms of economic activity growth for a couple months in a row. The UK has not gone that far, but the growth story is certainly disappointing. We've been basically trending toward weaker growth than since April or so, where we peaked for this year. So we're looking now at an economy that really should be putting a degree of pressure on discretionary spending and starting to eat away at the influence of those kinds of categories here in CPI, and is plainly not doing that. Moreover, if we look at the way that economic data has performed in the UK relative to forecasts, just to get a sense of economic momentum, here it is a story of deterioration also. We can see here there has been a steady weakening in the performance of UK economic data relative to forecasts. So not only are things trending toward weakness, they're also weaker than expected. So not only is the economy weak, but the numbers that we see coming out here are weaker than even the forecasts have it. And so the upshot then is we really should be seeing, against these kinds of economic conditions, now for a few months running, a diminished impact from discretionary spending. And frankly, at least when it comes to recreation, what we're seeing is the opposite. Its contribution actually increased as an influence on CPI from October to November, and didn't change very much at all when we look at the hospitality side of things. which of course makes for a very curious conundrum for the Bank of England as it ponders what to do next. Now, it certainly makes sense that against this backdrop, at least on the inflation side of things, we've seen a hawkish adjustment in expectations, but also the Bank of England has to be mindful of the fact that it's operating as central banks do with lags, and has to be mindful of the fact that ostensibly the weakness that you're seeing in economic activity growth will invariably land you into a place where you have to start thinking about more stimulus, not less. So how the Bank of England is going to walk this tightrope will be very interesting to see. It's not dissimilar from the tightrope that the Fed's been walking, although there it's a little bit clearer. The Fed had an economy that looked like it needed more stimulus in September. It promised big things, 100 basis points this year, 100 basis points next. It's had to walk back half of its 2025 forecast in today's update, which is what gave the markets the indigestion that they got once they saw it, even though they were already priced for that. And so you end up then with a situation where there is a balance of risks and a fine road through the middle. And for the Bank of England, it's even more overt because the economy is weakening, which seemingly calls for cuts, but inflation, even though it ought to be responding, isn't. And so there's a difficult case to make for easing. So the way that policy decision-making happens at the Bank of England is it's actually a very straightforward democratic kind of process where the 9 members of the Monetary Policy Committee vote to either cut, hike, or hold rates unchanged. When we look at what happened the last go-around here, when the central bank met in November, we can see that no big changes here other than, of course, the policy change itself. Then the vote was 8 of 9 voted for the cut. Nobody voted for a hike, and 1 of 9 voted to hold. We're expected to see a perfect inversion of that this go-around, where 1 out of 9 votes to cut, 8 out of 9 vote to hold, and nobody votes to hike. The differences in these voting patterns will be very interesting for the way that the consensus is going to develop here. Now, if what we're seeing in recreation, if what we're seeing in hospitality basically speaks to baked-in labor costs that got nudged up there during the pandemic, much as those kinds of labor costs in these same areas got locked in a lot of the developed economies. If that's what's going on here, if this is basically service sector inflation that's stuck because of locked in labor that was hired at higher rates in the very tail end of the pandemic as things started to reopen, then the argument would be, well, what we need to do is we need to hold rates higher and squeeze the economy further to really get this inflation out. But of course, if the economy is already weakening and policy operates with a lag, you likewise don't want to overshoot. So how the Bank of England votes on this, which side of this policymakers are going to err on, that will be very important. And if the guidance seems like maybe even the 50 basis points next year look questionable, maybe the Bank of England isn't even prepared to commit to that, then another hawkish surprise similar to the Fed might be in store. And just to give us some context there, here was the response to the Fed. Shocking this should not be, considering how much of a hawkish surprise the markets seem to find here. We get about a close to 3% surge in bond yields across the curve. Big move in the 10-year, big move in the 2-year of similar magnitude. And then a similar magnitude decline in the S&P a 3% down day. You likewise, of course, get a sell-off in the NASDAQ. That one's a little bit jumpier in general, and so not surprising that this percentage change is a little bit larger. You also get a sell-off in gold as the dollar rallies and yields rally. Euro off over 1%, yen close to 1%. Bitcoin, obviously a kind of digital foil to fiat currency and also to yields, since it doesn't yield anything, gets absolutely shellacked today, down almost 6%. Not surprising in a higher yield, higher dollar environment, and also a risk-off environment, as we can see on the stocks side of things. But what this tells us is a sense for how markets feel about monetary easing here, which is to say risk appetite wants their rate cuts. So if the Bank of England follows the Fed example to some extent and essentially says, well, we're not going to fight the Fed, nor are we prepared to say that inflation is doing what we need it to, because clearly it seems to be ticking in the wrong direction, and those things that need to be coming out of it are not, even as the economy slows. If that's the way this goes, well, then the upshot becomes very similar for the related markets. And in particular, where this is most interesting is the British pound, where, as we can see, we had a sharp move lower today as the dollar rallied, but we didn't really cross the Rubicon, as it were. We tried to dip back below support at the 126 level, give or take here, but we're still sort of within this digestive zone down here. If we get a more hawkish Bank of England, this has the possibility of reversing higher and bouncing off these levels. And so this will be a really interesting thing to watch, because, of course, if the Bank of England decides it wants to pay more attention to the economy and look through the latest inflation numbers and say, well, we expect that eventually this economic weakness will catch up, then the story becomes very different. And then you build on this move and perhaps even break through this low at about 24.50 or so, near the 25 figure, and extend further down. The major support here, of course, the lows from just before mid-year, late first half at 123. But anyway, you slice it here, the pound is coiled up for a move, and the Bank of England is walking a very narrow path to try to balance these conflicting influences. So almost any way you slice this, an expansion of volatility seems to be on the cards. Which way this breaks might well be the start of something either way, be it on the upside or the downside. And so opportunities here seem to be very interesting indeed. And that is Macro Money for today. As ever, we are here right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on in just 30 minutes time, as we mentioned at the top of the show, on the price of truth with the great and powerful Victor Jones. That's going to be no doubt a spicy conversation today as we unlock all of what's going on around these markets. So definitely come and join for that. I'm back with Chris for Futures Power Hour Fridays and Mondays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply. Join the club, genius. Tasty Trade.
I know I got swag. I know it's tasty. Yeah, I know.
much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah. Get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
So I've been trading for about 5 years, maybe 8 to 5 years, and I got in the options world because I wasn't making enough just holding long equity. You know, there's not a lot of strategy. It's just sort of like buy it and then pray it goes up. I found tastylive from my friend, and I started looking at the YouTube videos. My favorite part about it was just that there was math, there was probability, it was something you could consistently rely on. Once someone gets the right information, which they provide on tastylive, they can really change their financial situation for the better. Consistently, not, oh, I bought a stock and it went way up one time, but how can you do it consistently, over and over and over? And with tastylive, I was able to do that.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Katie McGarrigle. Where do I start? Crypto for Beginners, episode 9.
Niner.
How are you?
I'm doing well. How are you?
Yeah, pretty good.
Yeah?
We're getting through the week, right? It's hump day, Wednesday.
Cruising?
Yeah.
We're
I like
not
Thursdays.
boozing, but we're cruising.
Not boozing yet.
I saw they popped some bottles out there.
Without us.
Without us. How rude.
Per usual.
Yeah, I know.
We always get left behind, Katie.
I know. Maybe there'll be some leftovers when we're done.
Maybe.
We can only hope.
Katie, we got to shout out the chat. We're streaming live on YouTube. If you're watching anywhere else, get over to YouTube if you want to type something crazy into the chat. Grumpy Mike, what up? VW Diesel Dork, what up? Those are the only two I see thus far. So if anyone else types in there, I'll scream out your name as well and say, what up? Where do you want to go first, Katie? This is going to be the last episode of Where Do I Start? I think you're going to continue to spend some time with me on air. We've got a lot of exciting things planned for next year, but it's going to be our last show of, I guess, pre-Christmas season. I'm out next week. I don't know what your plans are, but I'm not doing this show. Okay.
That's okay, though. You know, it gives people a chance to miss us.
Yeah.
You know?
I'm sure we'll be
You want to,
missed.
like, have a little mystique, a little, I don't know, je ne sais quoi, so that when we come back, it's going to be even better.
Coming back, bigger, faster, stronger, 2025. This will be the last one for a week or so, but we will be back on Monday the 30th. Last episode of Where Do I Start? We're going to talk about DeFi, liquidity pools. We talked about Uniswap a bit on the last show. Before we do that, though, a little bit of volatility in the market today, Katie.
Indeed. A little choppy chop after that little FOMC announcement.
A hawkish rate cut, as I understand it, and everything's unraveling. I personally think this is a dip to be bought. In crypto specifically, but in other areas of the market. How are you thinking about things over the last couple of hours? Because this is pretty quick unwind. I mean, the VIX went to, almost 30, maybe almost doubled.
Yeah.
3% down in the S&P. I mean, that's a big move post FOMC.
When you get the text from your dad, like, hey,
Oh,
what's
no.
going on? That's when you know.
That's when you should be buying the dip.
Maybe.
Yeah.
I mean, I'm with you.
The fear is real.
I think I don't think that Santa Claus. Mikey said it earlier in one of our side chats. He's like, "Uh-oh, Santa Claus fell off his sleigh before the rally." I'm with you. I think he maybe just lost his footing a little bit. I think we will see a little bit of a rebound. But as far as crypto goes, I wanted your thoughts on that because this is my first, I'm trying to think of when I bought like my first little bit of like Bitcoin or ETH, first or second FOMC announcement. And this is obviously the first one I feel like we've had a material reaction.
Yeah.
So what are you thinking in terms of like how does it normally work when you see, you know, these larger market moves in terms of like correlated assets kind of all falling at the same time? Or do you just tend to see a little bit more volatility in terms of price action?
You definitely see more volatility with the price action. I think as a result, you see the correlation strengthen. So there are periods of time where we see this positively correlated. There's a strong positive correlation across risk assets when you're moving higher. Right. You do see that at times. But like everything else, correlations go to 1 on those down moves. So you have a risk-off move. There was a catalyst today. Jerome Powell, FOMC, interest rate cut, but maybe not as dovish as everyone had priced into in terms of the forward projections into the market. So you see that correlation strengthen. How long does that last, though? Mm-hmm. No idea. I don't think it persists. I can look at pockets of crypto right now, some of the areas that we've talked about that are interesting, whether it's in memes or it's in these AI agent tokens and other areas of the market that in some cases, you know, we've got stuff that's up 10 to 20%. When I look at the move to the downside, well, yes, everything is selling off. You know, we were down a lot more in percentage terms, you know, a couple weeks ago.
Right.
Down 4.5% right now. So a little bit of a recovery. We've got ETH back towards 3,700. This is kind of normal course of business. I think if you're, excuse me, I've got something popping up in my chart. But yeah, just looking at a couple of things here. I mean, we got TradingView up. You know, so what? It takes you to the bottom of the range off of the top of the range. We're going to ping back and forth in between that. We were here just a few days ago when you look at Ethereum. If we go back to Bitcoin,
Right.
You know, same thing. I think your range is, you know, probably 105, 95, 110 to 100. But I'm looking to buy pullbacks here.
Okay.
You know, still structurally very bullish. Aside from the fact that, yeah, you know, maybe caught a little bit of levered longs off sides with the commentary here following the FOMC. I don't think anything has changed necessarily.
Yeah.
You know, could this be a redo of, I think, 2018 in December?
Oh, yeah.
You know, we were, this was, I think, the Fed hiking or attempting to hike and then kind of had to reverse that. There was a little bit of volatility in the market. Maybe it's something similar to that. I don't necessarily think so. I think when you look at the kind of more macro picture, still pretty supportive from that kind of growth inflation perspective. So yeah, again, just long-winded way of saying, I think, you know, you have an opportunity to buy the dip. Does that dip extend into the mid 90s? Possibly. We know again that Bitcoin can move 10, 20% in a week. So down 4.6% on my screen right now isn't that crazy. I don't think you rush into it, but you know, in terms of how you think about it, I mean, maybe that was it and this is the beginning of the end, but I don't think so.
Yeah, I tend to agree with you. We'll see, right? I mean, and the interesting thing about this is that it trades 24 hours. So, like you're saying, you don't have to have like this lull period that like the futures are closed right now, right? And so is the U.S. market. So you can just keep watching it all night.
That's a great point too. And I want to expand on that, and that this is not just a U.S. thing. It's not the S&P 500. It's not a single stock. Do things like interest rates have an impact? Absolutely. We've done some research previously looking at this, though, and there's not that strong of a correlation. Over time, this stuff has gone up. So with a limited data set, it's hard to find a very strong relationship given that it's trended higher and you have volatility in between. Some FOMC announcements, it's up a lot. Others, it's down a lot. But there really isn't a strong correlation between that announcement and what happens, you know, within the moments thereafter or the following day. We can't forget, though, that this is global. It's an internet digital asset. Yeah, rates matter. The Fed matters. Absolutely matters to global markets. But so does, you know, Chinese liquidity, liquidity out of the ECB, you what the Bank of Japan does, what the Bank of England does. Like those things matter too. Sure. And so again, I just want to reiterate the point that this is so much more global in nature that I think Fed interest rate decisions probably matter less over the long term. Like, you remember what happened in the S&P, the last FOMC decision? Like, do you even know if it went up or down?
I mean, I'm assuming it probably went up a teeny tiny bit.
I don't know. I don't remember, but I think you kind of apply a similar perspective here.
Exactly.
I don't think this was a make it or break it FOMC announcement for the future of Bitcoin.
Yeah. Well, something that I want to reiterate really quickly before we actually get into the meat of today's topic is that we have a couple of new digital events live on tastylive.com. And one of them, if you are just tuning into Where Do I Start Crypto Edition for the first time, Ryan is actually going to be doing our January digital Tasty Live event. So everything you wanted to know about crypto, but were too afraid to ask, hosted by you. I'm super excited for it. You can also sign up for 2 other events that we're going to be hosting in February and March. Yeah, look at that. Great pick of you.
Not bad. They found one good one.
Hey, trust me, there are so many
it's the lighting.
Awful pictures that are probably floating around after having been here this long. But yeah, sign up, tastylive.com/events. It's free. You will get access, of course, to the airing of the digital collectible, and it will be given to you as a collectible after the fact.
Yeah, you can see the others here that are coming in 25 as well. We got Dr. Jim, Mike, his friends, and his whiteboard.
Yeah.
So,
I wonder who his friends are.
I don't
guess
know.
we'll find out.
Yeah, I'm excited to meet his friends.
Yeah, I'm excited to meet his friends too. I'm excited that he's reviving the whiteboard though.
Hell yeah.
It's going to be great. So anywho, I just wanted to give you that quick little plug because I have just gotten so much out of this, very short series with you. I'm looking forward to continuing it as we kind of enter 2025. But if you want to get caught up while we are, in a lull period, you can, of course, rewatch all the archives that we've already done, and then you can catch up again in late January.
Yes.
It's going to be dope.
Well, you want to wrap things up, talk a little bit more about DeFi, Katie?
Yes, I do, because it is still an elusive space to me. I sat in with a meeting with you and Shelly and Tom today, and Lawrence, and I think I got every third word.
Okay.
So I'm excited to continue to discuss all of the applications and uses of DeFi. So what are we kind of talking about today in that space?
I want to throw up the slides here. And today I want to talk about the other side of what we illustrated on Monday. And that was decentralized exchange. On Monday, we talked about decentralized exchange, trading tokens on a permissionless peer-to-peer basis through a protocol, a platform, whatever you want to call it. But in this case, Uniswap, trading through the Uniswap decentralized exchange as being a very pure form of DeFi. What represents DeFi? We're talking about decentralized finance and this concept. Here's a real use case, which is just trading tokens, but without a brokerage firm, without the New York Stock Exchange, without some of those traditional intermediaries or counterparties that you would think of. Instead, it's just using smart contracts, using code. Mm-hmm. So we talked about that. We hit on Uniswap a little bit. I want to talk about where that liquidity comes from and how you can also participate in DeFi as, I suppose, a market maker or a liquidity provider. Mm-hmm. And you can generate yield by allocating your capital to facilitate the trading process.
Okay.
In the same way that you have market makers that facilitate the trading process in the traditional sense, you can play a similar role on chain as an individual. And it can be quite lucrative.
Okay. I'm curious. Tell me more.
All right. Real quick primer on Uniswap, decentralized exchange built on Ethereum. We've talked about this last show. We've talked about this many times on the show. You can swap tokens. You can also provide liquidity. You need to do that from a self-custody wallet. You have to have control over your keys. You have to be able to sign the transaction yourself, and that gives you the ability to interact here. So you need a self-custody wallet. You plug the wallet into the exchange, connect it to the exchange, however you want to think about it, and then you can participate in this way. A couple high-level things, more jargon, stuff to explain here. This uses an automated market maker model instead of a central limit order book.
Okay.
So there's not really a bid ask in that sense. You have a single price that's through an algorithm. Automated market maker is the model.
So is there slippage? Is there arbitrage?
There is, yes.
Okay.
Yep. All those things exist. And all those things help to, in some ways, keep the market in line. Arbitrage opportunities do for sure. You interact with smart contracts to execute trades. We talked about that. You don't have a counterparty. You just interact with the code base, if that makes sense.
Yep.
It's non-custodial, self-custody wallet. You maintain control over your funds. So you don't have this risk where the exchange is the custodian in the way that FTX was, right? So you are always in control. You're just using this application, but you remain in control of your capital. It's trustless and it's permissionless participation. You simply just connect and you use it.
Okay.
So that's Uniswap. Liquidity pools are one of the ways that you can participate. The liquidity pools themselves facilitate this automated market maker model. So the trading works because liquidity is provided in these pools. It's provided by individuals, institutions, you name it.
My question is like,
anyone can participate.
okay, so is there a single wallet for the institution as well? Or do you think that that's kind of dispersed?
It's the same for everybody. Now, you might have infrastructure that has varying degrees of security that's internal to that firm and its own risk controls.
Sure.
But the way that you participate is the same. At the end of the day, that big hedge fund has a wallet, and you have a wallet, and you're interacting in the same exact way.
Got it. Okay.
Now, what kind of security surrounds that wallet and what services support it might be different than what piece of software you use, but you're interacting in the same way.
Got it. Okay.
So where are we? So liquidity pools and liquidity providers facilitate this whole process. To do this, to facilitate the process, you deposit a pair of tokens into the pool. I'll show you this and it'll make more sense in a second when we look at Uniswap. But if I want to provide liquidity for people to trade Ethereum against US dollars, so just ETH priced in dollars, I've got to have some Ethereum, I've got to have some US dollars. I bring both to the table, put them in the pool. That facilitates the trading process.
Okay.
When people use the exchange, they're either buying or selling one of those tokens. So if people want to buy ETH, what's actually happening is that they're selling USD and they're buying ETH, or in this case, USDC, the stablecoin. So that pool is going to reflect that for every trade. There's going to be more or less of each one of those tokens coming into the pool. It's called a constant product model, which is going to be used to calculate the price. But at the end of the day, the output is a price of the token based on how much of each one is in the pool, or a price for the pair. In this case, what's the price of Ethereum?
Sure.
So in the pool, if there's less Ethereum because people are buying it and they're putting dollars in, they're selling dollars, the price of Ethereum in dollar terms should go up.
Right.
If it doesn't, well, then that might present an arbitrage opportunity that you could take advantage of. Because over here, you can buy something that's cheap relative to where the rest of the market might be.
Okay.
I know that's a lot, but we'll make it real in a second when we take a look at the protocol. The thing that's important about this in providing liquidity is that when you're using this platform, Uniswap, to trade, I want to buy ETH, I've got stable coins. You're going to pay a small fee, 5 basis points in this case. When you trade at Tasty Trade or any other brokerage firm, maybe you pay a commission, there are some associated fees.
Sure.
The difference here is that those fees go to the people providing liquidity.
Okay.
Those fees are charged on the notional value of the transaction. Those fees do not go to a company. They don't go to a brokerage.
Yeah.
Go to you, the user. In a way, you can run your own brokerage on a blockchain 24/7, collecting a portion of a fee that's charged on the notional value of the transaction. And when things are humming, like they have been over the last month or so, and this month's been pretty good as well, there's a lot of capital that flows through this. And if you're providing liquidity to facilitate the trading, you're making a lot of money.
Yeah.
Like we're talking about annualized rates that are at times, and you just look at the 24-hour period and you can annualize it. So it's not perfect. It's going to be wildly variable. But well over 50%, in some cases well over 100%.
Is there a minimum amount that you would say you would need in order to start participating?
Used to be that you would need a lot more money because the gas fees were so high on Ethereum. When I started doing this, you really only could do it on ETH. And you would pay, $60, $100 in gas just to put your pool on. If you wanted to rebalance it, do something with it, interact with the network whatsoever, might cost you another $25, $50. So you had to have enough capital and you had to have a return that generated something, well in excess of the cost to put it on.
To offset it, okay.
Nowadays with layer ones, to set some of these pools up, it might be a couple of pennies. So $500, $1,000, I think is a pretty good starting point. So a minimal amount of capital on a layer 2 like Base, Polygon. You could do some similar things on Solana, but we're talking about Ethereum here today. So we're probably going to run out of time, Katie, but I'll try to get through a bit more of this and show you the protocol and interacting with Uniswap. But how do you participate? We're going to take a look at that in just a second. One, get some crypto in your wallet, connect your wallet. So get a wallet, get some crypto, get on chain. Once you're on the Uniswap protocol, you select your token pairs, you set up your pool. I mean, it's pretty straightforward. I'll show you the interface in a second. And then once you do that, you're in.
Yeah.
Generating fees, you can make some changes to your pool, but why don't we just look at it instead of talk about it? Because you can do this in the Tasty Crypto wallet. We've got the DeFi dashboard now. You can do this with the browser extension. You can connect to Uniswap with a browser extension. So just very quickly, and then I want to jump to the browser because I do have Uniswap pulled up there. But here is the current version of the Tasty Crypto wallet. Here's our DeFi tab. Click on Uniswap, and that'll take you to the protocol. You can connect the wallet. We're working on this automatically connecting.
Oh, sure.
But you still have to go through that step and connect the wallet. But you can do that in the upper right corner there.
Either with like your phrases.
Oh, no, this is just a pop-up and you hit another button.
Oh, beautiful.
It's just signing a transaction and basically logging in. You can think of it that way.
Okay.
What we'd like to do to make it easier for people is just push the button and you're automatically logged in.
Yeah.
You can see on here a few other ways that you can interact with DeFi. So a lot of exchanges, Aerodrome, PancakeSwap, Radium, and Jupiter. Those are on Solana. So you want to trade some of these memes and other things that we've been trading. You will go there. OpenSea, you can buy NFTs, that sort of thing. But Uniswap is what we're talking about today. That said, let's jump into the browser. And I want to show you the other side of this, the liquidity pool side. Because if you recall, we were looking at swapping through this interface last time. The wallet is connected here. So you can see we've got a little bit of capital in here. Probably can turn this into dark or light mode, maybe a little bit easier to see if we turn it into the dark mode. So our wallet's connected. Straightforward process though. You just click the connect button and then click wallet connect. If you're using Tasty Crypto, you can find the Tasty Crypto app on there, or if you use something like MetaMask, whatever, some of those bigger ones pop up first. But point being, connect your wallet. Once your wallet's connected, the app is able to read what's in that wallet. So it knows, how much of each one of these tokens we have. You can see we've got a couple different chains in here, a couple different tokens. That said, this is the trading interface where we can swap ETH for USDC and any other token that we want. What we want to do next, or instead, is go to pool. So here you can see all of the pools. We've got wrapped Bitcoin versus Ethereum. So this is Bitcoin, Ethereum on Ethereum. USDC, Ethereum. Ethereum, USDT. Another stablecoin, US dollar Tether. So you can see that these pools here are listed by TVL. This is total value locked. You can think about that as the amount of capital in the pool.
Okay, that's what I was going to ask.
Here is the extrapolated or estimated annualized percentage return. And then here's the one-day volume. My advice, if you're just getting started, is to probably go into something that's a dollar base, because now you only have to deal with the volatility of one token. If I'm trading a pair like Bitcoin and ETH, I've got to be aware of both their notional value, the volatility. They are correlated, but does that correlation ever break down? Sure. So if you just trade ETH versus dollars, or you provide liquidity that way, it's a little bit easier to get started, and you remove the volatility from one side.
Sure. It's like trading, kind of like a micro currency future or something along those lines, as opposed to a cross, right? Where you're like Euro sterling or Aussie Canada. So I get like not wanting to overcomplicate it right away.
Yes.
Okay.
Yeah, I would stick with this, and I would go into something that's got a decent amount of both TVL and also volume. And so you can see here that TVL is 143, but volume is almost 4 times that. So this is turning over quite a bit, which means that a lot of trading activity, a lot of fees. In the last 24 hours, this pool of $143.9 million generated almost $250,000 in fees. Decent.
Yeah.
Decent return. You can see the makeup of the pool and some other details, and you can just watch as the transactions go through here. So you can see that there's a lot of trading activity that occurs on here. It's not anywhere near what you see in traditional markets, but it's growing, and there's trades that occur frequently enough that you can generate some yield. So all that said, Katie, I want to now set up a pool or kind of just walk you through how you think about it. Very easy to do that. Here we can see some details about the different pools and then what chains they're on. Here we can create a new position. So when you create a new position, the first thing that you have to do is select the token pair.
Okay. Which 2 you're going to be entering into the pool.
Exactly.
Got it.
In this case, I want to do this on Base because it's a lot cheaper. So I need both Ethereum and USDC on Base, which we have a little bit for this example, like $40, $30, somewhere around there. But just make sure that you select the token and then it's also on the right chain. So you can see there's...
you know that that's on Base because of the small little icon in the lower right of it.
Yeah, you have to know that this is the Base icon, I suppose, but this is the Base icon. This is Ethereum on Ethereum. It is a little confusing that way, and there are a lot of L2s, but you'll see Optimism, Arbitrum, you'll see Polygon. This is Base. This is Coinbase's L2 Base network. And you want to make sure that the token that you're going to put into that pool, I mean, this is the way that you would do it, is also that same network.
Got it.
So for here, it'll tell you the fee or the pool that you want to be in terms of the fee tier. When I first started this, the fee tier was 30 basis points. It's crazy. But that was on Ethereum. That was bigger transactions, lower volumes. What you've seen is that this has shifted over time. It's the lower fee, higher volumes. There's more money being made, even though there's a lower fee tier.
It's like a ticket charge back in the day.
Exactly.
On the trading desk.
Once you do that, and we are going to run out of time, but the next thing that you do, and we'll continue this conversation into the next show, is you just set your range for where you want to provide liquidity. I'll use a 1 standard deviation range for a weekly basis, given whatever the implied vol and the spot price is. You can provide liquidity across the entire thing, but if you concentrate your liquidity, it's a more efficient use of capital in that for the range, you're going to be providing liquidity only there versus the whole thing wherever it trades. So you're going to get more fees, if that makes sense.
Sure.
So once you do that, you click continue, and you then just simply pick how much of the balance of each token that you have you want to allocate to this. If you were to click the max and you have the appropriate amount of both ETH and dollars, you would just then click review. That'll ask you to sign your transaction. You create your pool. And I don't have one loaded up here, but next time I'll show you a couple live pools. It looks a little bit like a strangle in that you want the price to stay above the low end of the range and below the high end of the range. And as it trades around there, you just generate fees. Then you can collect your fees or shut down your pool. But this is a way to put your capital to work. You are effectively constantly trading ETH for dollars at different prices around this curve, but you're receiving a fee for doing that. And so if you're bullish ETH, and you put this pool on, this looks a lot like a covered call because you limit your upside. When it goes out of range to the upside, you've basically sold all your ETH, so you just have dollars. So you're out of range, but you've generated that return off of not only the price appreciation of ETH as it's gone higher in the range, but also the fees that you generate as it just chops around and trades going up there. It's not a straight line necessarily. A lot like a covered call. You have a yield in terms of the premium from selling the call option. You cap your upside. You are bullish. You do want it to go up to that short call strike. But here, you're participating more like a market maker and constantly generating fees as it goes both up and down and chops around versus a static premium received for selling the call option.
Okay. Yeah. This is super fascinating to me. If one really quick question. So if you were to flip flop those and do USDC on top in this example and then ETH on the bottom, that is a different pool?
Nope, same thing.
Okay.
Yeah, you can look at it and set it up that way too. So I could set the price range up as USDC or ETH, just depending on how I want to look at it.
Okay.
To me, it's easier to see it priced in dollars.
Yes.
But yeah, it's the same thing. So the ETH USDC is the pair. You might have people that are buying ETH, selling dollars, or vice versa, buying dollars and selling ETH.
Got it. Okay.
So selling ETH $4.
Right. You're just there on the dance floor.
You're the market maker.
Yeah.
The market maker is the algorithm, but you're providing liquidity for the algorithm to make markets. And the algorithm, people can read the white paper. They can learn a bit more about how this works. There's a lot of similar mechanisms across decentralized exchanges. But the fact that you, as an individual participant, can allocate risk capital to facilitate the market making process and then generate fees as a result, I think is pretty interesting and real use case here of DeFi.
Ryan, I'm very, very excited for what is to come as we close out. Where do I start? My learning journey is not over.
Yeah, we're going to naturally keep this going, and we'll be back on Monday the 30th. But I think we're going to start to trade a bit more, actually do some of these things that we've talked about, put our money to work, talk markets a bit. And I'm sure there will be almost this educational component to it, even though it's not where do I start.
Yeah.
You'll have a lot of great questions. Hopefully I'll be able to answer some of them, and we'll go forward.
I'm sure you will. All right. Well, if I don't talk to you, have a lovely, time off.
Thank you.
Away.
You too.
You deserve it. And hopefully
You
we see a
too.
little rebound this afternoon and into tomorrow.
All right, fingers crossed. That's going to do it for our show. We'll be back in another week or so. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Explain pot odds.
Pot odds is my favorite term, but pot odds in the poker world or gambling world refers to having a greater payout than your implied odds would suggest. So let's say I have 3-to-1 odds to win a pot, but the pot is giving me 4-to-1 odds to make that bet. I would have a positive expected value over time. So in trading, let's say you have a defined risk debit or credit spread that's currently at a max loss, and let's say there's 30 days left to go. There's not really a reason to close that position because you're already at max loss. You can only go up from there. So in that scenario, that would be a positive pot odds scenario or something that would give us pot odds to stay in.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
yeah, it is Wednesday, December 18th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast called The Price of Truth, where we explore the incentives that govern our world. I am your little host of this little wacky show, but you're not here for me. It's Wednesday, so you're here for the one, the only, the global head of macro here at Tasty Live, Ilya Spivak. Ilya, how you doing, my friend?
What a day! What a day!
What a day! What a day! That's right.
I'm still processing what we just saw.
They don't. The chat doesn't have room for your gloating, my friend. But yes, finally, the market does have two-sided. I'm not giving it to you. I'm not giving you that pleasure. The market, my friend, has two-sided risk. For anyone who, this is a show where we celebrate trading, and yes. You need two-sided marketplaces. And some part of me wants to smile and gloat with you, my friend, because I saw some post before the announcement. It was like hawkish cut equals bullish, dovish cut equals bullish. Neutral cut equals bullish. It was basically like no matter what they say or how they say it, Ilya, that number only goes up. And at some point, you got to keep the markets honest. Otherwise, this is going to get real stupid to the upside real quick. And you're not going to like the downside reflexive move that you'll get on the other side. Tell me, my friend, tell me why the markets moved down today. In your opinion.
I actually did not get what was on my bingo card today. I was thinking that the Fed was going to be a little bit more gradualist than they ultimately were, but clearly the markets were responding to the Fed adjusting their outlook for rates next year. And in my mind, it was even less about the adjustment itself and about the tone with which Powell made it, because he was out there in almost completely different guise than we've seen him recently. Obviously, we're talking very nuanced because central banks don't say bombastic things as a matter of course. But the key here, you can very clearly see in the view for the summary of economic projections, which was always where the action for this meeting was going to be. The markets had the rate cut fully priced in for weeks now. This was not going to be anything that was going to move anything or inspire anyone. It was a fait accompli a long while ago.
Yeah,
So-
there was no Paul Revere moment where somebody's like, "Oh my God, they're cutting everyone, they're cutting."
Wait a minute, what?
That's my favorite. By the way, that's my favorite part of days like today is that there is some part of the financial media world or just financial world, big or small. I'm not really sure how big this world is that always like thinks it's the cut or not. That is the news. It's like, no, we know that. know
that's never the news. That's almost never the news. If the central bank somehow changed policy in a way that wasn't at least significantly baked in, that's almost like central banking malpractice. Like, you didn't do enough. Your communication strategy sucked, and you didn't tell the markets nearly enough.
That wasn't always the case, right? Greenspan would just cut rates out of nowhere. But I just think post GFC, and in a highly leveraged economy, global economy, it's really difficult to just come out there and just nobody knows what's going on, and then you're either going to cut rates, raise rates with nobody knowing. That's highly unlikely today.
Yeah, I mean, I think you hit the nail right on the head. Basically, during the 2008 crisis, central banks around the world, at least around sort of the major central banks, basically decided that forward guidance was their friend, and that what they didn't want to do was they didn't want to shock anybody into anything. They didn't want to create credit market volatility. They wanted to walk markets into things. I would argue Bernanke's taper tantrum in 2013 was sort of the poster child for things you don't do when the markets are jumpy. He basically came out and was like, at some point, sometime, maybe we might have to raise rates. And the market said, what? Raise rates?
What the hell are you talking about?
He's like,
Tell
I
us
said
when
maybe
and why.
at some point. What in the world? And the market lost their mind. He then spent a year talking them into it. So the cut here was widely expected.
Right.
The Fed basically came back in September and said, we're going to give you 100 basis points in cuts this year. Here's half of it up front, and there's 2 meetings left for the year. Wink, wink, nudge, nudge. There was almost no stretch at all to say, okay, so you gave us half, so you give us another 25 basis points in November, another 25 basis points in December. There's not enough time for you to change your mind. These things are done. And indeed, the big change was next year.
Agreed. So let me set that part of the conversation up. Again, if you're just tuning in and you just see the big red candle on your screen or the candles on your screen, the NASDAQ was down, and this is the cash market. The NASDAQ was down 3 2/3%. The Dow Jones was down 2.5%. The Russell was down 4 2/5%, and the S&P was down nearly 3%. So it was a pretty nasty, a decent nasty day to the downside. Big red candle. We haven't seen one of these in a while. The big catalyst today was the FOMC announcement. So effectively, we got a statement from Jerome Powell today. We got a rate cut today. We had a summary of economic projections, which we're going to go over in just a minute. We also had a Q&A, a question and answer session with the Federal Reserve Chairman and pretty much the most trusted journalist from the Fed's point of view, the most trusted journalist to ask questions. Is slightly after that. So we had been talking about what to expect in this summary of economic projections. I think we said likely there's not going to be much change to growth. There really wasn't. They upticked it to 2.1% in 2025. They downticked in 2027 to 1.9. All else equal, that's really, they shuffle a tenth of a growth, a tenth of a percentage point here and there. Not a big deal. They also trued up 2024 by moving it up to closer to reality.
Which at this point is backwards looking.
Right, exactly. 2024 does not matter at this point. 100%. Good point, Ilya. The next thing that they did was, or that their projections did, they claim that they don't do this on purpose. They claim to be totally independent, submit their own independent projections, and this just the median is what it is.
We're just penciling some things in, baby. Don't worry about it.
Yeah, we're totally. I would bet my last dollar that's not true. But anyways.
We'll read the minutes.
They downticked on it. We didn't think there would be much change in unemployment. Again, they shuffled a tenth of a percentage point here and there. Not really a big deal. They took it down in 2025, but they raised in 2027. PC inflation, we said this is one where we'd see a decent amount of change to the upside, just given that we've seen a re-acceleration of inflation. It did not get down to those September projections. They're going the opposite direction, and this is a big one. 2025, they moved up from 2.1% all the way up to 2.5%, which is somewhere closer to where we are right now.
That's a meaningful.
It is a big one. It is a big one, but we also said that was you and I think Chris all agreed this was the likelihood that we'd see 3 big changes, and this is one of the 3. The third was core PCE. They ticked this one up in 2025. So core and headline at 2.5% into 2025, which is you're nowhere close to the Fed target. You're nowhere close to the Fed target at 2%. We're going the opposite direction.
The way Powell talked about it in the press conference today was pretty funny too. He was like, maybe we'll get there in a year. Maybe we'll get there in 2 years. Who knows when we'll get there? But are we on track? Of course we are.
This is going to be the new carrot. This is going to be the new thing that 2.5 is just going to keep moving out in time. And then this was the big one. We had said this is going to be the big change. 3.4%. You can't do 3.4. The last time they put out 3.4% as their Fed funds the Fed funds rate projection. When they did that last time, Ilya, in September, we kept calling this out. Let me put it in front of people. We had a very different rate scenario, right? The 2-year and the short end of the curve was down at 3.5%.
Yes.
So it made sense at that time to say, in September, to say that the median path for 2025 for the Fed funds rate is 3.4%. That made sense.
Yep.
That was in the ballpark of reality, and that's what the market projected.
Yep.
And that's what the Fed came in at. In a world where the 2-year is now at 4.2% coming into today, that's not possible. So we had said, I had said on this show, I said 4% is your midpoint. If they want to be super hawkish about this, it's 4.1. If they want to give themselves some room here, it's 3.9. And 3.9 is where they came in. I'll pat myself on the back. But those are,
I was very happy with what happened in September. Those were a great 2 months for me.
When it came to the numbers, when it came to what actually was in this SEP, for us and for anybody watching this show, there's basically no surprises, man. There's no surprises for us in what they said.
I mean, if you've been looking at Fed
implied
funds
market,
futures,
what the implied, they just basically blessed the implied market.
They did it again.
Ilya?
This is bizarro September. They did it again, only now in the other direction.
Explain what you mean by that.
Fed comes out in September and gives the markets all of their dovish myth making. And goes, all right, you know what? Here's 100 basis points for this year. Here's 100 basis points for next year. Everybody's right.
The Oprah method of central banking.
Yeah, everybody gets a car. Everybody gets a car. You get a car, and you get a car, and you get a car.
You get a 25 basis point cut. You get a 25 basis point cut.
Yeah. We got a tiny Hyundai for all of you. So the story in September was the Fed basically talked themselves into a real sort of dovish state of mind. And this is why it's so important to watch economic data. When people come out there and go, economic data doesn't matter, you just want to hit your head against the wall. Because this is what ultimately moves the markets to bet this way or that relative to the Fed, and then what gets them to change their mind and bet the other way, because the Fed is not on the same reaction function as markets, and markets oftentimes front run the Fed, and very rarely is the Fed actually opposed to this. The Fed wants the markets to front run them because they don't want to shock the system. So what happens in September? Why is the Fed?
What you just said is the most important realization, which is the markets are front running the Federal Reserve's reaction function, but also the Federal Reserve is banking on the market front running their reaction function as a shock absorber to the volatility that we're in. That's the level of reflexivity and two-way sort of game theory happening right now is wild. Agreed.
It's a dance. This thing is a dance. So everybody coming out there screaming, oh, the Fed was wrong. And the Fed goes, oh, yeah, we were wrong. Wink, wink, nudge, nudge.
Maybe. Okay.
Yeah. So what happens? Why is the market so dovish going into September? And why does the Fed then bless them? Because from mid-April or so into that meeting, U.S. economic data is going the wrong way. It's weakening relative to forecasts, and the markets go, oh, my God, the Fed's going to miss the boat here. The recession is coming. They've tightened massively. This is the most aggressive rate hike cycle, at least since Volcker, and maybe even more aggressive than Volcker, ultimately, in terms of how fast everything occurred. They're going to kill this economy, and they're going to kill it with a delay, because the cost of borrowing didn't bite as hard in this tightening cycle because all these corporates hoarded on 0% credit during COVID. But it's coming eventually. These are 5-year loans and 3-year loans. They'll reset, and they'll reset 300, 400, 500% more expensive because these loans were incurred at basically zero. And now they're going to get refied at 3%, 4%, 5%. So they're going to kill this economy. Oh, my God, the data is turning. The That was the whole panic in July, where the Fed finally goes, okay, we're ready to cut. And the market goes, yeah, you're too late. You're already scrambling. The recession's here. And then the Fed comes out and says, here's all your dovishness that you wanted. Here it is. But by then, the economy has already turned the other way. Already by late August, things are heating up again, and quick. And the market goes, there is no way in hell that you are going to do 100 basis points next year. You just did 50, and you're going to do 50 more this year, and then 100 more next year? No. You're dumping stimulus on an economy that's going the other way now. What's going to happen is you're going to reflate the economy, and you're going to cut back on these rate cuts. You're going to change this. And so yields go on a tear. The dollar goes on a tear for 2 months.
Real quick, just so the visual makes sense, what people are looking at as Ilya is explaining this. The yield curve in red is where we started on the Fed's first 50 basis point cut. So this lines up with what Ilya is saying. The next one, the green line is the yield curve at the second cut in November, and the blue line is where we are now. So you can see as the short end is coming down with Ilya's rate cuts, the long end is sort of lifting, and we moved out of inverted territory.
Yes.
Go ahead, Ilya. Keep going.
Absolutely. So yield curve steepens, long end rallies, dollar rallies. As the market goes, there's no way. No. You are not going to do 100 basis points next year. You're reflating the economy. And what ends up happening is by mid-November, we have this massive move in the dollar. We have a massive move in yields. And the market goes, okay, really it's like 50 basis points next year. That's what you'll do. The Fed helps along. Powell comes out in November. He gives a couple speeches. There's a policy announcement. And he's like, yeah, maybe we kind of got a little over our skis in September. The economy has been stronger, but we're not trying to extrapolate too much. The data has been volatile, but we're not on any kind of dovish autopilot. Take it easy. So he sort of endorses this rethinking that September was too far, that forecast was way too dovish. My thinking was going into this meeting, they would go from 4 cuts to 3 because they're saying we're going to look through data volatility, because we're going to look through inflation being a little bit stickier, because they think they're still on course. Reading their commentary, that's what they've been saying. And then instead, what they do is they go, no, the market's right, 50. Mm-hmm. And they basically go exactly where the markets are. And I guess I wasn't the only one that thought they were going to be more gradual, because the stock market looked at that and said, wait, they went the full 50? They cut it in half? Mm-hmm. Uh-oh. And
in other words,
Powell comes out and he's all kinds of combative, like, the economy is great, so much better. I expect another great year next year. La-di-da. And they go, oh, no, the cheap money. Yeah. Where's the cheap money? And everything dumps.
In other words, if you're playing the game that I think you're articulating, or you ascribe to the narrative that you are articulating, what you're saying is there are certain points in time. So the Federal Reserve has what they call basically a sledgehammer, and sometimes they need a scalpel. And so sometimes they need multiple tools, and that tool in the tool bag is jawboning. It's effectively their forward guidance becomes a tool without having to actually cut or add liquidity, remove liquidity, without actually having to implement QE or QT or raise it or lower it. They can use their words to try to implement or influence the financial conditions in the marketplace.
And they're very successful at this.
Yeah.
Very good at it.
What it seems like you're saying is precisely at a moment when the market, they felt they needed to add liquidity in the market. They did so. The market then reacts. the market reacts by saying you're going to create inflation, and they start to tighten financial conditions by steepening up the curve. So rates are going higher, and the curve is steepening a little bit, and that creates ever so slightly tightened financial conditions. But that's happening at the same time. It's happening just they did this. If they were right, they did it just at the right moment, just at the inflection point of the economy, as the economy started to get stronger. Because what you would want as the economy starts to get stronger is you'd also want the curve to start steepening, rates to start rising to hopefully offset some of the strength in the economy.
Yeah.
And if this is working, we're just going to ping pong up and down from strength, hot to cool, hot to cool, hot to cool, until this sort of all this crazy excess liquidity can sort of burn itself off. We can normalize into sort of this sort of normalized range instead of going hot, cool, hot, cool, hot, cool. But we are every 3 to 6 months, the macro narrative is completely shifting. 6 months ago, we're on the 6 months ago, we're on the verge of recession, and everyone needs to potentially look at buying bonds.
This is how markets think, right? Markets are jumpy.
Yeah, this is how markets think for sure. And then on the other end, you're getting. We're in the fourth industrial revolution. We're on the cusp of an AI breakthrough. We've got quantum computing. We've got biotechnology that does this, that, and the third. And so, I believe from Citrini on Twitter, a great Twitter follow. He basically said if they get this, he goes, if the macro narrative is shifting every 3 months or so, from basically recession to euphoria, that's probably what a soft landing looks like. A soft landing probably looks like every 3 months you're in the complete opposite scenario, and everyone's
or a horrible crash.
I don't think that's a soft landing. I don't think that's the definition of a soft landing.
No. But I'm saying it's one of those things.
Correct. Sure.
Right? When sentiment is that volatile and people are that back and forth.
Yes.
Around this, either you've achieved one of the extremes. Either you've beautifully landed the ship, or something is terribly wrong.
See, but the problem is, and I never thought about this as we got into this, the problem of running these 6% debts, 6% deficits, is that you're almost forced to be a participant. So normally there's not a forcing function that keeps you invested if we're going on this crazy whirlwind, very volatile macroeconomic narrative with all these geopolitical risks and everything else. But the deficits, you don't believe this part, but the devaluing of money, that potential, that is a forcing function to keep people invested and not to run out and not to create the potential sort of stampede for the exits. And I never really appreciated that as a forcing function to keep people invested. I knew that it was there, but I never thought about it as conceptually as this forcing function that keeps people from running from the exits in a world of just this back and forth volleying of monetary policy, of fiscal policy, of unknown geopolitics. You can't just take your ball and go home. You can't just take all your cash, put it in a pile of dollars, and just sit there. You have this forcing function that keeps you invested right now. Well, in a world of price stability, you wouldn't want to, but the pain of taking your money out, sitting in cash, and just waiting for some sort of
watching the market
normalization
rise in your face.
Right. But what I'm saying
That's
is
the problem.
that pain is much worse in a 2.5% inflation world, which the Fed just put on paper.
Yes.
Right? They just put it on paper.
Yes.
And they gave it to you. They said, this is the world we anticipate you to be in. Well, in the 2.5% world, the risk of me putting my money in cash and going home is much different than in the 2%
100%.
target world.
100%.
And that's all I'm saying.
No,
that's
I agree.
What I'm saying.
I totally agree. I don't think this has anything to do with the fiscal deficit per se.
No.
I mean, certainly.
Okay. You're fair. Why we're in that world? Let's put that to the side.
Yeah, I mean,
sort of some differences.
And by the way, the fiscal deficit is certainly a part of it because we're spending money like we're in the middle of World War II. Right? And to say that that's not a contributor to inflation being sticky is lunacy. Of course it is.
Thank you, my friend.
Of course it is. Of course it is.
I thought we were gonna. But sometimes you like to debate all the way down to the nuts and the screws.
You can't debate things that are real and obvious. I mean, where I have interest in debating you is in sort of what it means to define currency devaluation. It's really it's more a semantic conversation than saying when you dump a ginormous amount of fiscal stimulus on an economy that needs maybe half of it at best, you're going to get inflation.
Yeah.
Of course you are.
So let me ask you this. We've gone through the obvious cut, the cut we knew was coming.
Yes.
We've gone through the summary of economic projections, and it worked out pretty much the way I expected. I think what you're saying is the market and yourself didn't expect this. You weren't expecting 3.9. You might have expected 3.7, 3.8 is what you're saying.
Yes.
You expected them to leave the door open more.
I thought they were going to put 3 cuts there, not 4.
There.
Here's how I've started to think about.
You mean 3 cuts?
Tell me if this resonates with you.
Okay.
What I'm starting to see in September and now here, the Fed is basically engaged in judo. What is judo?
Using your body weight or using your own motion against you.
Yeah. So your opponent charges you, right? And the natural tendency is to resist, right? The Fed's like, no. We're not going to resist. We're going to use the force of you running at me to throw you off balance.
So good. That's so good, dude. That's exactly right. It's so good.
This is judo. The Fed is doing judo. So the market goes, we want all this dovishness in September. And the Fed goes, okay. And the market goes, wait, what? You're supposed to push back. Now we have to push back? We have to do this ourselves?
Yes.
Uh-oh. And the markets trip over their feet.
Oh, that's so
And they just did it again.
That's so good.
The market goes, we need all this hawkishness. And the Fed goes, okay.
So then...
and the market trips over their feet again.
So here's what you're saying.
Look what's going to happen now.
Is you think the market over-rotates here, and you actually think... Because this is what I've been betting.
It's got to go back now.
This
is going to be bizarro September.
I was betting that this is the pinnacle. This is where not for the exact reason you articulated, because you articulate it much better. But I thought on the opposite end of this, we'll start moving the other way.
Yes.
So when they start cutting, rates are going higher and we steepen. I don't know if we invert again, but I think the curve perhaps steepens but moves down. This is as high as we're going to go.
Yes.
And I think the market is going to start pricing the other way.
And I'll tell you why.
Go ahead.
I'll tell you why. This is I have not laughed this hard when the Fed did this and the markets responded this way in a while, because I'm like, oh my God, they just chucked the market over their shoulder judo style again.
Mm-hmm.
Because what happens in September, right? We just said by the time the Fed gives them what they want, U.S. economic data has already started to heat up.
Right.
So when the markets see it, they go, holy hell, what?
Mm-hmm.
You're not going to push back? All right, we got to do this ourselves. And for 2 months, yields go higher and the dollar goes higher and they rejigger the entire thing. Well, guess what? Since mid-November, U.S. economic data has been cooling.
Yep.
And again, the Fed goes, oh, really? You want all this hawkishness? Here. Notice, 10-year didn't break its low today. 30-year kind of sniffed at it, but it didn't get very far.
Yeah, but
gold got to the bottom of its range, but didn't break.
30-year got murdered. 30-year got murdered.
It did. No, it did. It did.
Yeah,
but nothing like what you saw in stocks.
Yeah, fair.
And so you look at what the 30-year did, and you're like, okay, but did you really break out? You look at gold. Did you really break out? You look at the euro. Did you really break out? No. And so I'm looking at this and going, right, this was probably peak hawkish. Now we're going to start looking at economic data that's cooler for the next few weeks. And the market's going to go, oh, man, we overshot on the other side. Reel them back.
To me, I read basically, if we were playing liar's poker, I would go, they lied about everything. So to me, I go 0.1% increase in GDP means be concerned about growth in 2025. To me, the fact that they went down from 4.4 to 4.3 in unemployment means expect the unemployment rate to go up. We're like a hair away from 4.3. So you can say we're already at 4.3. So I would say you expect the exact opposite of what you're seeing in this unemployment rate. I'm not going to go so far as to say that inflation's going to roll hard. I'm not going to go that far. Because I really don't have confidence in what inflation is going to do.
No. Really, that's a conversation for like mid-year.
I agree. But I would also bet the opposite on Fed funds rate. I think at some point we're talking something between these two numbers.
Yes.
We're
not talking
right
2
bet.
cuts. We're probably talking 3.
Yeah.
But we'll see. I mean, obviously, and you heard this from Powell today, a huge set of wild card risk here, assorted wild card risk, is what comes out of fiscal policy. And the other one is what comes out of geopolitics. Because what's happened in Syria is important. And what's happening in Washington, D.C., vis-a-vis the tariffs, any disruption to labor markets because of a sweeping up of immigrants, anything like that. All of those things have implications for inflation. And so there's a lot of kind of weirdness risk going into next year.
Dude, your phraseology is absolutely beautiful. All right, let's do this. Let's make this more actionable. So, what is it like? Do you think today is just markets were just offsides? Like, I can give you a couple of scenarios. I can give you scenario number 1 is the summary of economic projections surprised the markets and the markets were offsides. I can give you that. I can give you scenario number 2 is this FOMC announcement ends up being sort of a pivot day where the market was pricing and positioning for one thing out into the future 3 months from now. And now, given what whether they cared what the Fed said or not, the point is we got a catalyst, and then the market sometimes on
this
a
was
catalyst
the last
big
event risk of the year. They wanted to go down. They wanted to get to the other side of it.
They're choosing to pivot into what they believe is coming or positioning in the next 3 months. Or scenario number 3 is we had a little bit of excess into the markets, and it was easy money to run into all the excess bullishness and just take all that money for 100 points in the S&P and 1,000 points or something like that in the NASDAQ. It was just easy excess money to extract out on this catalyst, and that you shouldn't read too much into, even though it's a big percentage move. It's quad witching week. The markets were super extended. It hadn't given anything back. And this is just what happens in a marketplace. And this was a good catalyst to do it. So there's 3 scenarios. One is the market was not expecting what they got. The second is this is a pivot point for the market to think about the next 3, 6, 9 months. And the third is this was just excess. Don't over-rotate on a changing narrative in the marketplace. We just got 3% of excess taken out because we had gone too far, too fast without anything on the opposite end. Which one of those three flavors would you bet on today being?
I think the answer depends on whether you're looking at the next couple of weeks or whether you're looking at the next couple of months.
Okay.
I think if you're looking at the next couple of weeks, I think you're going to find that finding follow through on these moves is going to be difficult. I don't think stocks collapse in a hurry here. Mind you, I am still short. So if they do, I'm not going to be mad at it. I put on the Russell short for basically 2 weeks now because it was the first to turn before anything. So thank you. I've been sitting on that Russell short for 2 weeks now. Earlier this go round, I put on a SPY short because SPY wasn't going anywhere basically since the beginning of December. The Russell was doing what it was doing. It was falling. And NASDAQ was catching up because it'd been lagging what was a much more explosive run, bless you, in both the S&P and in the Dow, basically since September. Let's recall, what did the markets do if we look at the S&P with what the Fed did with this reflation narrative? It ran stocks higher. Stocks started to break higher on September 19th. That was the day that the S&P really cleared July's freak out high. But NASDAQ didn't make that move. So December, NASDAQ was catching up. S&P wasn't going anywhere. So I looked at it and thought, okay, well, NASDAQ's playing catch up, but the S&P risk reward wise looks like it's stuck. Let's take a shot. And so I had that short about a week and a half now, about 8 days, maybe. So I'm on the short side of this. But I think if you look at the S&P, if you look at the NASDAQ, you sort of start to think, okay, well, why follow through here? Everybody has basically every reason to go to sleep now. Event risk is over for the year. So what you probably now do, start to be concerned about your high water mark if you're a money manager, any kind of asset, buy side, anything. You go, you know what? Let's buy it here. And let's erase, let's say, half of this red bar over the course of the next few days. So I'm not necessarily extrapolating imminent collapse. But I think what this does tell you, longer term, is that a bigger shift is coming. Because what this did, especially in the S&P, NASDAQ held on a little bit better. It held November's swing top as former resistance come support. You can see it on the chart that we're looking at here. When you look at what's happening in S&P, you've crossed a bigger Rubicon. The entire up move from August here has been invalidated. You've set a lower low. You've broken down. So what you end up with then in the S&P, I think, is a larger shift. And there is every reason to look at next year and go, we just had a year of anticipating rate cuts. We don't have that next year. We had a year of anticipating the election. We don't have that next year. We had a year of all kinds of things going right in the AI space. Who knows if we have that next year? A lot of the build out is there. A lot of the hype is there. A lot of the valuations are there. Now we have to start thinking about, well, what happens if the tariffs really come? Does that disrupt the story? What happens if the labor market disruption really comes and that disrupts the story? These things stop being hypotheticals. Now we're going to start looking at fiscal policy for real as it actually occurs. And so I think when you overlay that with the idea that everybody's free COVID money is due to reset in 2025 and 2026 en masse, all of those loans, if you think about it, they're basically 5-year loans, mostly. It's 5-year money. This is, The Economist did a chart of this together with the IMF. It was an amazing chart. It showed that every single tightening cycle but this one, since the dollar got untethered from gold, so basically going back to 72, 73, every single tightening cycle has seen U.S. corporates pay more for debt through the tightening cycle to service it, except this cycle. Because everybody got all that cheap COVID money. Well, now it's all due. So if you look at all of this collectively, I think you start to see a much greater risk to equities next year, especially if the Fed is like, I don't know how much we want to cut, and give everybody a cushion. Rate cuts, to some extent, are almost better as a speculative bogey than as something that's already arrived, because as ever, the markets are always asking, what have you done for me lately? Markets are forward looking. If the cuts are already here and the Fed is already going, I don't know, that's not nearly as good as anticipating, on the one hand, that you will get a cutting cycle any day now, and on the other hand, anticipating that you're going to get a business-friendly administration in Washington that's going to lower taxes on corporates, that's going to reduce regulatory burdens, and in all kinds of ways unchain corporates to go and make more money. So a lot of that is gone next year. And so as a speculative catalyst, next year it's no longer speculation. It starts to become reality, but of course the markets have spent all of this year pricing that in. It's in the market. And if anything goes wrong now, let's say the tariffs have a bunch of unintended consequences, as they usually do, like retaliation. Let's say the sweep up of immigrants, if it were to occur or even be attempted, let's say that creates a bunch of chaos because a bunch of states resist. And if they don't, you get a disruption to labor. Prices go up. The people start to wail. The stock market doesn't like it. We know the incoming administration watches the stock market as a barometer of how it's doing closely.
Both of them do. Everybody has.
Everybody does, as well they should. But we know this administration is not different in that sense.
I agree.
And so we're going to see maybe a whole bunch of risk where there wasn't that before. So I think near term, I wouldn't go, oh my God, this thing is going straight down. We're in free fall. Good night, nurse. No. But as a preview of what the first quarter might look like, yeah.
No. I want to say that like that. I agree with you. I look at what the VIX did today, 2760. But VIX futures didn't really move that much at right around 19. I mean, I don't say they didn't move that much. They did move, but at 19.5, it's a very different picture of the VIX cash versus VIX future. So the VIX futures curve is flat but not inverted, and cash is like well above future. So I would probably say this might be done. You know, you get that 4% move in a day, instead of bleeding 1% over a week, 1% down, a quarter percent up. The markets, I think these models are so efficient, they get to the right price, and then we just go there to the downside. So your 4% move happened in a day, and I don't know that I would bet on massive continuation here in the very short term. To your point, I would agree with that, and that's the way I would probably trade this. I've closed out some of my short futures, but because I was early, excuse me, there wasn't much profit for me on the future side. But luckily I had this trade on a different, I don't want to say luckily, I don't know if it's lucky. I wish I would have just had the option side of it on. Those things paid. But anyways, I want to ask you a question. Something came up in the chat, and I'm curious to get your reaction, because not only did you have the monetary policy, and I haven't even asked you about the Q&A yet, but you also had sort of the continuing resolution, this drumbeat of the continuing resolution happening in the background. And J.D. Vance or Vice President-elect J.D. Vance and President Donald Trump put out a joint statement.
Yes.
It's a long statement. I'm going to read most of it, if you don't mind, just for context for everybody out there.
Sure.
Because I want your reaction to this.
Sure.
So they put out this joint statement today. The most foolish and inept thing ever done by congressional Republicans was allowing our country to hit the debt ceiling in 2025. It was a mistake and is now something that must be addressed. Meanwhile, Congress is considering a spending bill that would give sweetheart provisions for government censors and for Liz Cheney. The bill would make it easier to hide records of the corrupt January 6th committee, which accomplished nothing for the American people and hid security failures that happened that day. The bill would also give Congress a pay increase while many Americans are struggling this Christmas. Increasing the debt ceiling is not great, but we'd rather do it on Biden's watch. If Democrats won't cooperate on the debt ceiling now, what makes anyone think they would do it in June during our administration? Let's have this debate now, and we should pass a streamlined spending bill that doesn't give Chuck Schumer and the Democrats everything they want. Republicans want to support our farmers, pay for disaster relief, and set our country up for success in 2025. The only way to do that is with a temporary funding bill without Democrat giveaways, combined with an increasing debt ceiling. Anything else is betrayal of our country, and this is where it gets interesting. Republicans must get smart and tough. If Democrats threaten to shut down the government unless we give them everything they want, then call their bluff. It is Schumer and Biden who are holding up aid to our farmers and disaster relief. This chaos would not have happened. Blah, blah, blah. So
every side does this. Every time
side,
that there is an increase in the debt ceiling and the other side is in power.
Correct.
This happens every time.
Yep. And I remember Schumer and Pelosi sitting in that meeting, and it was just Trump. And Schumer tried to set Trump up, right? And he said, "So you're saying that it's your responsibility. You'll be at fault if you shut down the government?" He goes, "Yeah." Trump goes, "Yeah. I'll do it. You could blame it on me if you want to. I'll do it." And then Schumer got this gigantic
Schumer
smile
sitting
on his
there
face.
Keep talking.
Because that's what that's all he wanted was that leverage of blame. Yeah. But this is to your point, this is working the other way. My real question, and I do not want to go into politics here. My real question is, to what extent do you think this impacted the picture of risk today?
I don't think it did.
Okay.
I don't think it did, because I think the markets are smarter than this. I think the markets look at this and they go, you guys have this stupid thing which is completely antiquated and means very little to anyone, because you raise it every time. And you raise it every time because of course you do, because that's the responsible thing to do. What kind of a fool would sit there and say, I am going to allow the world's most eligible borrower to flirt with default, not because we can't pay our debts, but because of a stupid statute that's on the books for no particularly good reason. Debt, as ever, is not about absolute levels. It's about your ability to pay. If you can pay the debt, then it's not too much debt. A person that can go into a car dealership with 10 years of great income and lots of assets and a high net worth is going to be able to buy a really expensive car with a really low interest rate. Why? Because they're credit worthy. They're good for it. The very same car is going to command a very different interest rate from somebody who's not as credit worthy, because it's not how much you take out, it's how much you can service. And the U.S. is the most eligible borrower in the world, for all its warts, which are many. But there's no more eligible borrower. Everybody else's warts are exponentially worse. And so if you are going to look at this from a market's perspective, the markets are going to go, well, this is stupid. Because what's going to happen is you're going to raise the debt ceiling. Because nobody is going to not raise it. You're just going to jockey until the 11th hour, as you usually do, and try to score political points off each other and go on everybody's favorite networks, one side on theirs and the other side on theirs, and wag a finger and yell and scream. And in the end, you're going to pass this thing because nobody's trying to have the U.S. default or to claw back any level of meaningful spending. You'll get a deal done, whatever. This circus happens every time.
We find a point of contention in almost every episode, and I think we just found it, Ilya.
Good.
I'm going to pull a thread.
Yes, pull the thread.
I'm going to try to figure out the way to say this, because I feel like if I say it correctly without stumbling over words you'll take objection with, then I think I've got a decent chance of you acknowledging. So I think you are right that a high net worth person goes into a dealership and it's their credit worthiness is what matters.
Yeah.
But even a high net worth person can rack up enough debt to where their interest payments have now crowded out,
of course,
other potential purchasing decisions.
Of course.
So I think when we have the debt conversation, I hear you. I do hear your point, but I don't think anyone's having that conversation. I don't think anyone's having the question about debt as in, is the U.S. good for it, or can we pay it back? I don't think that's the question.
I agree,
right?
and rightfully so, which is why we're going to increase the debt ceiling every time, because the entire exercise is stupid.
I'm not.
Do we have a longer term debt problem? Of course we do.
Yes, that's where I'm going. I'm not.
No, of course we do. We agree there.
Okay, cool. Okay.
We
I
agree
knew if
there.
I said it the right way, then we would.
We agree there. We agree there. I mean, Jay Powell would agree with you.
Yeah.
I mean, anybody who's watching the longer-term fiscal trajectory of the United States would tell you have a problem. Right. Because what you have is a crowding out.
Correct.
And you can't have that happen. And it's really funny how now everybody has learned the new talking points on this from every side of the equation, right and left.
What do you mean?
Well, have you noticed that everybody has started to come out there and say, what we really got to do is we got to grow our way out of it.
Yeah. Yeah.
And that's become the new religion, right and left. And it's funny. It's always funny to watch politicians learn economics in real time.
Yeah. Yes.
with like a 20-year lag.
Yes.
Always funny.
That's so true.
I love watching politicians learn economics as though they knew it the whole time. Right? Like, so there's this wonderful book out there. It's by Marko Papic, who used to be an economics and geopolitics analyst at Stratfor, the same place that Peter Zeihan is from. And Marco Papic was sort of, I don't know if you can call him a Peter Zeihan understudy, but he was kind of in that world. And he was the younger guy, and Zeihan was the senior guy. And Marco Papic wrote this really great book called Geopolitical Alpha about sort of.
I was trying to think, where's that? I know the name. It's a good book. That book. Good book.
It's a good book. And one of the ideas that he talks about in terms of analyzing politics and their impact on markets is this idea of the median voter, and how the preference of the median voter rules, even in societies that don't vote. So you look at China and the end of the zero COVID restrictions. And in the end, people are in the streets. And this is China. You'd expect people are in the streets. Where's the tanks? No, we're just going to end zero COVID. Because at the end of the day, the people are too numerous, and no government can withstand what is the consensus. And if the consensus demands a view, right, left adopts the view. We see this in the attitude to globalization from both right and left. Used to be a wedge issue, not anymore. We see this in the attitude toward immigration increasingly, everywhere, not just in the U.S. Used to be a wedge issue, not anymore, increasingly. All of a sudden, everybody wants to protect everybody's border, right and left, everywhere. Because the median voter in Western developed countries has spoken on a lot of these issues, at least for the next however many years. Their opinion will change, and then politicians will change again. But this artifice of difference between right and left on a lot of these issues goes away, and the debt is one of these things where all of a sudden everybody's like, we got to grow our way out of this debt. Yeah, that's right. There's this thing called the debt to GDP ratio. And what we all saw as the fringe benefit of the inflationary spike, which hurt everyone, but had one positive externality. It made the debt more manageable because it inflated away a bunch of debt. And now, central banks have been busy beating back inflation because, again, the median voter everywhere said, our cost of living is out of control. You all are nuts. Go fix this. And all the central banks hiked a lot. And everybody all of a sudden, cost of living crisis. Rightfully so. That's where the median voter was. Everywhere. US, Eurozone, UK, Canada, Australia, Japan, of all places. Everywhere. So, okay, central banks said, right, we're going to go fight this thing. But now, no more inflation to beat back the debt. And debt to GDP ratios are starting to creep higher, and the only economy really growing in the world is the US. The UK is at a standstill. The Eurozone is shrinking. China can't figure out how to turn the car on. They've lost the keys somewhere. It won't even start. So at this point, it's like, well, what if the US missteps? What happens to global debt to GDP? It's a nightmare. And you can't hinge it on one economy. At this point, there's no safety net. Let's say the tariffs get pushback and there's a trade war for real. That's going to hurt GDP growth for everybody. Let's say there is a labor shock going to hurt everybody. And so you look at all that and you go, well, if the U.S. screws up here and U.S. growth slows, especially if all these loans come due and suddenly companies don't want to splash money out there like they did, suddenly everybody's tightening their belts and the U.S. economy slows, we have an issue. And so everybody has adopted, everybody's learned economics suddenly, and they're like, debt to GDP ratios. You can bring them down by slashing debt, or you can bring them down by increasing GDP. Let's all find ways to increase GDP. We have to grow our way out of this. And of course, the flip side is higher rates. That's now the conversation. Everybody's going to start to look for ways to boost growth now, except Europe can't seem to get their act together. We'll see if maybe that's the big outlier. If the big surprise next year is Europe figures it out. I'm sort of I'm sort of looking at it. I'm a little bit long euro here.
Would you only express that view through the euro and not things like VGK? Because that's one. We've been having this discussion about Europe for a little bit, and as they've been going on deeper and deeper discount, some of it erased in the last month or so. But that's one that's been on my shopping list of things to shop for outside the U.S. I don't think they've done enough damage to things like VGK, but I would like to get some more European exposure. Why would you specifically want your exposure to be in currencies and not any equity risk?
I don't mind VGK. Okay. I think VGK is interesting and in fact more interesting than, let's say, FEZ or EZU, which is just the Eurozone. VGK is all of Europe, including the UK, including sort of non-Eurozone markets. This is interesting. It's at an interesting spot. It's at former resistance becomes support. It's holding it here. My concern is that there is a risk-off thing that makes correlations go to 1.
Yeah. I don't think they've done enough damage. I think
not yet.
If I was looking to just pick some of this up, buy it, and forget it, I don't think they've done enough damage. But let me. You set up a really good point just a minute ago. I want to go back and pull a thread. The point you put out there is just how sensitive the global economy is, and that there is one economy that is stronger, much stronger than the others.
One ring to rule them all. Yeah.
And you put out this but if. And the but if, there were a few there, but the two that you called out seem to be mostly Trump policy. So let me pull on this thread.
Yeah.
One was tariffs, that the threat of it potentially popping the balloon that is the U.S. GDP, the U.S. economic strength that then is the final domino that creates this, this potential crisis scenario. And the second is labor, which you would get if you had this sort of mass deportation event.
Maybe.
So,
and we'll see.
Potentially. So let me pull these two. The threads that I would pull is from a market participant who has to hedge risk. I think that's the exact right frame, the right framing to think about this, and the right risks to be aware of, and the right risks to be trying to hedge. If you were a politician, though, and one with a mindset for negotiation, knowing where are your strengths and where are your weaknesses, where are your, let's say, the person on the other side of the negotiating table, where are their strengths, where are their weaknesses. If you know that most partners are economically weak, you're economically strong, and you have you're able to create this potential leverage point, these tariffs. Don't you think that you can see why somebody has this set of incentives to put these out there to then get better deals at the negotiating table?
Of course. And I think this is the real question. This is what we have. This is what we have to learn.
Right.
Because, for example, you start to see a little bit already. I mean, obviously, you already hear from people like Lutnick, from people like Besant, that the tariffs are a negotiating tactic. And you already see a little bit that world leaders are feeling like they could be that and not something that's, let's call it, ideological. Because if you were to ask a Peter Navarro, he would spin you this dystopian ideological nightmare, which in my mind bears very little resemblance to the way that economics works. But he's got a horse and he's riding it. This is his perspective. I happen to think Peter Navarro was wrong about pretty much everything.
Mm-hmm.
But within Trump world, by the way, not dissimilar from how Reagan organized his administration, there is a diversity of views. And he's taking input from, at the same time, people like Lutnick, people like Besant, but also people like Navarro, and trying to find a middle ground. So yes, of course, I think it's possible that it's a negotiating tactic. His conversation with Claudia Sheinbaum after he went and like waved a fist at Mexico, then had a conversation with her, and all of a sudden they all come out all smiles after going, there's not going to be a trade war, and she's all happy and he's all happy. Sounds like he put his cards on the table and said, and she was like, hey, man, we're going to make a deal here. Take it easy. And got a favorable response. So it's absolutely possible that what this is a kind of negotiating first bid from a position of strength.
Mm-hmm.
I think Europe is going to interpret it in much the same way. I think Europe has something to give in that negotiation, because I think Europe recognizes they have to spend a lot more on defense. They know that the Trump administration wants that. And I think they take the combative rhetoric on NATO and they go, yeah, okay. How about we spend a lot more on defense? How about we figure this out? And we don't need to reinstate tariffs on aluminum, say. So I think there's a conversation to be had. The resignation of the finance minister and the deputy
That's where I wanted to go.
PM in Canada.
That's where I wanted to go next.
Was her screaming at her boss going, you got to engage with the negotiation, man.
Basically, she called him a doormat. I mean,
it's like, what are you doing?
I read the resignation letter on air earlier this week, so I'm not gonna do it again.
Well, and she was a huge architect of renegotiating NAFTA.
Somebody
she knows
called her,
what she's talking about.
Somebody called her basically the Nancy Pelosi of Canada.
I didn't even know what that means. But
meaning like in her position of power and influence. That's what they were speaking to.
I mean, I don't know her background enough. She comes from a journalism background. I know that. I don't know how long she's been sort of in the Canadian political stew, and whether she has the kind of cachet that Nancy Pelosi has, because obviously Nancy Pelosi commands a lot of influence. When you look at what she did, though, what Friedland did here was very clearly like, she looked at her boss and said, I'm out of here because you're playing gimmicks with baby giveaways instead of preparing the war chest for a negotiation, because that's what this is.
Politically,
the United States isn't adversarial to Canada.
Right.
That's crazy.
Yeah. She damaged him politically. I'm curious.
He was already so damaged. I'm not sure how much more damage there was to do.
For sure, but this is brutal. I mean, so
it's brutal.
It went from he's going to lose the election in I think October 2025. He's going to lose to Pierre Poilievre. To is he going to make it?
Like leave now, man.
Yeah, that's what they're talking about.
Just go. Just go, man. You've done enough.
Is any of that tradable from your view, the CAD in the CAD?
Yes.
Like how does that play itself through?
CAD looks like it's exceedingly weak. It would be crazy to try to pick this bottom, but it is something to keep very much on your radar.
What would a Trudeau resignation mean for this? Would it, do you get an immediate reversal, kind of like a bad company whose CEO gets replaced and you get sort of this relief rally? Is that sort of the
It's
framework?
It's the Liz Truss head of lettuce thing, right? Liz Truss goes out, she kills the British pound by being incompetent and by refusing to learn economics, even on the fly, the way politicians do. She puts out this bonkers budget, and all of a sudden the markets turn around and go, did you think that you all were the United States? You can't borrow with impunity. You don't have the global reserve currency. Who do you think you are? No, market discipline applies to you. We're not giving you more money if you're going to expand debt to this extent and not tell us how you plan to pay for it eventually. Get out of here. And she got run out of office. And the pound rebounded sharply as soon as that occurred.
So this is, if I was playing basically a Trudeau early departure, which I think is highly unlikely, low delta. But if I was playing that, then I would play some upside, some dumb upside in the CAD here.
Yeah.
The Canadian dollar.
Yeah. And I generally think currencies are better for this kind of thing than stocks are, because stocks have, first of all kinds of other things in the mix. And currencies are much more kind of attuned to these kinds of factors, bird's eye view, macro things. That's why I've had a really great time with bond markets and currency markets this year, and a frustrating time with equities. Because bonds and currencies have done what you might expect. They followed the macro clearly. But what you have in stocks has obviously been a pulling of the rubber band that's been a lot more dramatic.
All right, so let's do this. We've got 12 minutes left. I'm going to go instrument by instrument. Everything we've just talked about, we're now going to go high octane, make everything. That's the context, the background context with which to understand your feelings on each instrument. We're going to go instrument by instrument and tell me if you have a position, and if not, if you have an opinion.
Sure.
Would you like to start with currencies here?
Sure.
Why not? I'm guessing. Okay. We'll start with the euro, my friend.
I'm a little long.
And that is because of your feelings about Europe and the potential opportunities there?
It is because of my feeling that maybe the euro has gotten too cheap because people have gotten too negative, because the expansive easing that the ECB is likely to do has already been priced in, and because I think in the spirit of Fed judo, we're now on the other side. And so now bonds look like they're cheap, yields look like they're high, dollar looks like it's expensive.
Oh, I hear you, brother. I'm hoping you're right.
Me too. I'm a little upside down on this trade.
So does rent money for December. Rent money is hoping you're right too. British pound.
I'm a little bit short. So this has been underperforming. And whereas the euro until today was kind of stuck in a range, this was going lower, despite, by the way, an uptick in inflation that got reported this week. I'm a little bit short. So I'm of two minds on the dollar here, depending on sort of where you are in Europe. I'm a little bit annoyed that I got out of my Aussie short too early, because obviously today was a massive day. Should have stayed in that longer. I wrote it down almost all the way down from the peaks in September, and then I got out when it stalled 4 or 5 days ago. So I'm kind of annoyed that I didn't stay in. But for the pound, there's the Bank of England meeting tonight. They're not going to cut. That much is expected. Markets know this. The question is, how do they walk the tightrope? Because on the one hand, their inflation is sticky and won't go down. On the other hand, their economy has weakened significantly since August-ish and is basically back to standstill. We got the PMI numbers earlier this week. How the Bank of England is going to walk this tightrope will be very key. I might not be in this trade for very long if the pound bounces, if they are on the hawkish side of things. After all, their mandate is inflation. They don't have a two-sided mandate. So they don't necessarily have to care about the economy. They do, of course, but they don't have to, as a statutory obligation, care about the economy. They have to care about core inflation at 3.5%. Okay, so if they're hawkish, I got to get out.
All right, next one is the Japanese yen.
If I think that yields are overcooked on the top side, I got to be looking for yen gains.
Mm-hmm.
There's not a catalyst. There's not a signal yet, but it's one I'm watching closely and going, if I'm going to be long bonds, as I am already, I got a little early, but if I'm a little bit long bonds here, especially at the long end, I've got to be sniffing around a yen long as well.
We just talked about this one, but just to put them all together, Canadian dollar.
Got to watch this one. There's a lot of political risk here, but the moment this thing looks like it's getting ready to turn, this is a screaming buy.
And one I don't often talk about, but I'm going to start, Mexican peso.
This is another one where I think the median voter, the one thing the median voter doesn't want is more inflation. And the one way you get more inflation is you pick a fight with Mexico or Canada that's real, as opposed to a negotiation as you get into the reauthorization of the USMCA, which, by the way, is coming up next year. So all of these tariffs being threatened now ahead of that renegotiation, it's all real cute and convenient. They're going to renegotiate. So I'm a buyer of Mexico. I think Mexico has, just in general, I think Mexico has tremendous opportunity because everything that China was to the U.S., Mexico is becoming and will be. It is already a larger trading partner for the U.S. than China is. As of 2 years ago. More is coming.
Now we're going to get into dollar-denominated commodities here. Crude oil, a little bit of a head scratcher. Tight range, hasn't done much. Your thoughts?
So I think this is, aside from, I mentioned Syria as a kind of weirdness risk. If you look at what's going on in the Middle East, because obviously that factors into oil as a geopolitical premium of some amount. Iran is being defeated proxy by proxy by proxy. Hamas demolished. Hezbollah yelled uncle. Now Syria has fallen apart. The Russia-Iran power axis in the Middle East is crumbling. And Israel, along with obviously U.S. backing, is winning that contest here. So Iran has, unlike any time in recent history, an incentive to make a deal. I think, if nothing else, they have every incentive not to escalate and to kind of go in a corner and think about what they're going to do, but not to up the ante because they're losing. And so with that, geopolitical risk should come out of oil. And to that extent, supply and demand matters more. And supply is an ocean of crude. The U.S. already produces more crude, or just more petroleum in general, than Russia and Saudi combined. Record output. And the incoming administration only wants to do more. And can. Because one of the interesting things about this current record output in the U.S. is we've become so efficient that we've achieved these record output levels with the number of rigs going down, with the number of fracking operations going down. So we're getting record output out of smaller capacity. If we were to get a Washington, D.C. incentive to increase capacity and turn some of these rigs back on, that's only more supply. So I think what you end up with then is a situation where you're just waiting for this range to resolve itself, and the way that it resolves itself is probably on the downside. So you're not short yet. I'm not short yet. I've been short, by the way, all year. Anytime that there's a geopolitical spook, I'm like, yeah, but they don't really want this fight, short. And that's been working most of the year. I'm just looking for this range to crack now to really lean in and sell some more. I think it's going down.
All right, two more. We've got four minutes. Good pacing.
Here. I'll make this fast.
No. It's perfect pacing. 26.05. Nasty run in gold. Down nearly 2%. Not the worst it could do. We've talked about this before. A 5% day is probably like the death candle for gold. But your thoughts on gold here at 26? It found a reason in this range in the past. You know, I think right around the last time we got to 2,600 was when that report came out of additional Chinese buying. I think that was like December 6th or something.
Yeah.
Excuse me. Sorry.
Just last week, how fast these things go.
Yeah, a little bit longer. So your thoughts at 2,600?
I'm a little bit long. And again, it's that same idea. We're probably overcooked on yields. We're probably overcooked on the dollar. And we have a non-economic buyer that's back in the game and that's ostensibly figured out that this is a cheap enough level to start accumulating again. Because gold hasn't really gone anywhere between, let's call it loosely, September-ish, late September. It's kind of been in this range with a midline around 2,650, 2,700, something like that. So, yeah, we're toward the bottom of the range. If China has restarted buying in earnest, and last time they went on an 18-month scoop up everything that's not nailed down, kind of a buying spree, if November was a start, they're going to buy more. And on top of that, yields are maybe overcooked and the dollars may be overcooked. This could be something like a tradable bottom. I'm a little bit upside down on it. I got in a little early, but I'm not jettisoning it yet. I don't think that this is I don't think this is a collapsing market. I think this probably finds support not too far from here.
I just thought about something. That inflation rate, moving up inflation rate for 2025, 2026, and 2027, that changes the real yield. How you think about real yields. So if you believe they want to keep real yield at 2%, maybe I need to rethink how I'm thinking about bonds, because that's the one thing I didn't think about. So basically, here's where I'm going. Sorry to do this with like 1 minute left. If what they're saying here, is he playing me off?
We dared them to do this, and here they are.
I did yesterday. He's playing me off.
I warned you.
Okay, here's the last thing I'm gonna say. At 2.5%.
I'll let you finish.
That was beautiful.
That was the voice of production.
Well
Jesus
played.
right there.
Well played. At 2.5%.
It worked out perfectly. You didn't see this one coming today.
That was good. That was good. Not yet, buddy. Okay, I'm almost done. I'll be on in a second. Okay, Papa. Okay. All right. 2.5%. You add 2% onto that, and your 10-year yield is somewhere at 4.5%. So I don't know. I got to think about that. Yeah. Because we've been in this range of real yields right around between 1.5% to 2%. We've been in that range ever since mid-July 2022, and it seems like the Fed's kind of keeping us there between 1.5% and 2%, 1.5% and 2%, 1.5% and 2%. Anyways, my last thing for you would just be silver. Do you have any thoughts on silver? And that will close out.
I don't have as much confidence in silver as I do in gold. I'd rather express my view in precious in gold, because silver has this kind of mixed relationship.
Silver's tied to growth. Silver's tied to growth because of the industrial
it's tied
component.
to both. That's the weird thing. It's tied to both. And what I'm looking for in gold is sort of the precious metalness of it. It's foil to the dollar. It's foil to yields. It's buying for reserve. Right, I'm not looking for a risk-on pro-cyclical bet, which
That's
silver would have an element of.
Yes.
So I like gold. They can keep silver.
You've probably given 3 or 4 bars for T-shirts today. You know? I asked you what do you like about gold? The precious metalness of it. Ilya, if the people want more for you and more Ilya-isms, tell them where they can go.
As ever, I'm all over the network. Overtime and Macro Money are Monday through Thursday. We're here on Wednesday. You and I are both with Tom for First Call on Sundays. I'm with Chris for a Futures Power Hour Mondays and Fridays. I'm writing for the news and insights portion of tastylive.com. I'm on the formerly Twitter machine and the Blue Sky machine at Ilya Spivak.
All right, Matt, I'm going to give you one more chance to play me out here. If you want to follow me at Twitter, the handle is Victor Jones, at Victor Jones. Owen Jones is 0 because I like to be difficult. I'll see you back here tomorrow, same time, same place, same great network. Matt, play us out, take us out. Peace, everybody.